It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith and Madison Mills. This is Yahoo Finance Live, and here's what we're watching this morning. Producer prices declined sharply in October, indicating a welcome cooldown on the inflation front. This as retail sales fell in October for the first time in 7 months. Is this the Goldilocks economy that we've been looking for? Meanwhile, mega retailer Target managed better than expected earnings in Q3 to beat Wall Street expectations. But the bottom line is clear, folks are still spending less.
And President Joe Biden and China's Xi Jinping are sitting down at APEC, their first meeting in more than a year. Several U.S. CEOs are also on the scene, and we'll have a chance to speak with Xi later today.
Lower your odds of a government shutdown. A short-term funding plan heads to the Senate for a vote on after passing in the House. Now, the deadline is Friday evening. TikTok, because we know that clock is ticking ahead of that deadline. Well, let's start with the rally that we've seen this week. Futures edging higher once again this morning after we got a key reading on the state of the consumer. Retail sales during the month of October cooling as consumers pulled back on discretionary spending amid sticky inflation. Yesterday was a big day for the markets. The rally staged broad gains after October's CPI inflation report cooled more than expected. And Maddie, when you take into account what happened yesterday and then what the early action that we're seeing this morning in futures, all three of the major averages pointing higher once again, I think many on the street are asking whether this rally can continue and what exactly that upside looks like.
Right. There was a little bit of commentary yesterday about whether or not there was a little too much euphoria in that rally just because it was the biggest S&P 500 day since April. But I want to take a look at small caps because that could be one indicator that we are going to see this rally continue heading into the second half of the year, November and December there. If you look at the Russell 2000, up by 5.4% yesterday. That was the most gains in the Russell in all of 2023. And seeing some trading in those small caps could be an indication that traders that have had some dry powder waiting on the sidelines are ready to get in on some riskier plays because they've decided that, you know, the Fed, at least from the market's perspective, the inflation fight is over. We'll have to wait and see if Jay Powell agrees with that, right, guys?
And so on the retail sales front, I mean, we've got a range of data that either showcases a lot about the consumer, whether that's the inflation that they're still waiting through, that came yesterday, but also how much it's costing producers to produce services, goods right now. But then additionally, just where retail sales are holding up. We got that most recent print for October. What's the action that we're seeing across those names as we're considering and continuing to get more of a read-in on the consumer?
Yeah, I think it's really interesting that we saw that 0.1% decline in retail sales. The street was looking for 0.3%. That meh kind of number, some would call it Goldilocks, I call it meh, feels like something the street is excited about, right? Because it's not a sign that the Fed is going to have to continue their inflation rate hike to fight inflation. But it's also a sign that the consumer, okay, they're cooling off a little, but they're still going to spend money to keep those fundamentals good for those companies that are reporting earnings still. And we got some of that detail from Target and TJ Maxx this morning, beats from both of those names. I'm really curious to hear on their calls later today, and I know Brooke will talk about this with you guys, whether or not the story for those retailers is consumers trading down, and that's why we're seeing more movement into TJ Maxx, or if this is consumer resilience because of more credit, and that's not going to be a great thing either for the economy.
Yeah, and I think that's exactly what we're trying to figure out, right? We know that consumers have been under a tremendous amount of pressure when we talk about the fact that inflation has been sticky now for so long. So it's the fact that, yes, they are still out there spending. Many times it is on staples. But what was interesting in this Target report was that they did spend more than maybe we had expected on beauty. There were some areas that maybe would be considered a bit more discretionary, yet consumers are still willing to spend. And when you tie that to what we saw in the retail sales report that was also out this morning, yes, they are still spending on personal care. They are still going out and spending on grocery stores, but 7 of the 13 categories did post declines. We talk about people aren't out there spending on discretionary items, furniture, car dealers leading those declines there. So people holding back on some of those larger ticket purchases, which is very similar to what we heard from the earnings report in Home Depot yesterday.
Yeah, that's right. And for Target, I think that if there's anything that should jump out to investors who are trying to figure out why this stock is moving higher, 14% pre-market here, especially after the company had the number of transactions and average check size decline during the quarter. You also had comp sales down year over year, digital comp sales down 6%, and store comparable sales down 4.6%. 5.6%. All that considered, it doesn't spell out a consumer that's continuing to increase the basket size when they go into this store. And so being very nitpicky about where they need to spend versus what they want to spend on is one theme that continues to show up, and especially even within the most recent Census Bureau data that came out this morning around retail sales in some of those more discretionary categories right now.
Well, and then you consider the CPI data, the fact that the biggest contributor to the upside on CPI was housing. So if that continues to be the case, how long are we going to continue to see consumer spending? And to your point, Brad, if we're already seeing some cracks in the pavement here, what's that going to look like heading into 2024? Is this rally going to be justified?
Absolutely. Madison, thanks so much for joining us here this morning, helping break down the consumer environment. We've got a little bit more that we're going to discuss on that front, as today's top story is Target. It's Target. The third quarter results, the big box retailer beat analyst expectations for earnings and revenue. The company reported that it is facing the same challenges it has for the past year with discretionary spending. Comparable sales down almost 5%, partially offset by continued growth in frequency categories, which include food and beauty. For beauty category, that is one of the little luxuries. Heck, even I watch more YouTube tutorials on what to put on my face before this show, and that pushes me even more.
Do you want to share any tips?
Yeah, just make sure that it looks like I have a fresh haircut every day, I guess. But even that doesn't always work. At the end of the day, though, I mean, you look across some of the categories and where we were anticipating that student loan repayments would show up more in these figures. That did get brought up here a little bit, and it's going to be interesting to see what they have to say on the call, both about student loans, but then additionally here, in some of those grocery aisles, Target is one of the largest grocers that we have. Now, Walmart runs away with it when you think about the U.S. market share, but Target's still a considerable player within that, and so they have to not only answer for what student loan payments are doing, what shrink is doing to the business as well, and how they're combating that, but also maybe what Ozempic is doing in those grocery aisles.
Yeah, I mean, the reaction, I think it's also good to put this in perspective, right? We talk about there's a lot of excitement on the street right now initially following these results because of those very low set expectations. So yes, Target did report better than expected results, especially when it comes to the profit growth. They're up 30-something% here, 36%, 971 million in the most recent quarter. That was helped by tighter inventory and also just the execution that we're starting to see from management. And we know inventory levels have certainly been a focal point here for Target, for many of its rivals here over the most recent quarters. We continue to see that improvement. That's going to be a trend that we'll be watching for in Walmart tomorrow as well. The lower inventory levels of 14% on a year-over-year basis, but same-store sales did still fall. It was still a decline of 4.9%, so much less than expected, but still the second quarter in a row that we did see that slide. So yes, Target, I guess, better position than maybe many have been bracing themselves for, but still doesn't point to a consumer that's spending too much out there right now.
They still got some of my dollars on the body wash. I even sat there, waved my hand over the thing because the body wash was kind of, there's a little bit of friction when you're trying to get some of the home care, the body care, all of those things to have Self-Care Saturday go off without a hitch.
There we go. We're learning a lot about Brad and how you shop for some of your beauty products here in the first 10 minutes of the show. All right. Well, we got third quarter results from two retailers this morning. Target shares surging after it beat profit estimates. Meanwhile, TJX is under a bit of pressure as its boosted guidance falls short of what analysts were expecting. Here to help us break this all down and the reaction that we're seeing play out in the stocks today, we want to bring in David Wagner, Aptus Capital Equity Analyst and Portfolio Manager. David, it's good to see you. Let's start there with Target. What's your takeaway from the quarter? Because yes, the results were better than what the street was looking for, but when you dig down into this report, still clear pressure on the consumer, which obviously is a concern here for Target.
Yeah, well, first of all, I want Brad to send me his cliff notes on all the beauty stuff he finds out.
Got you covered, Dave.
I need all the help in the world being a Cincinnati guy. But when it comes to Target, I'm probably going to take the other side of this trade relative to how the stock market is allowing it to perform this morning. It's up like 14%. But, I think if you actually look down into this report, I think it could actually create another overhang on the stock through the increased volatility surrounding margins. But heading into this report, I was really focusing on three different things. The first one was actually going to be, I wanted to see balanced top line growth. But as we saw with comps right now, that would suggest, and to your point, Shauna, that sales, they're going to continue to decline. So that's strike one for me. Secondly, if you look at, I wanted to see some type of stabilization in shrink. That also has continued to not happen. So that's strike two in my mind. The last thing that I was focusing on here was, can the company manage their operating expenses? But if you look at the report, they got some benefits through some exogenous forces in my mind, like lower freight costs. So I guess they were able to do that just with some cost savings and some better, favorable mix benefiting margins. So it's not a complete strikeout for the company. But if you do focus on the third aspect there I'm talking about, and that's the margin profile, it seemed like it was pretty much a low quality beat there off of lowered expectations, because the margin was really driven just by merchandise getting a benefit of 3% year over year better margin expectations. But they benefited from lower freight costs, better digital fulfillment costs, and favorable category mix. So that was, offset by shrink. So it wasn't a great beat there. I do understand, that valuation is very palatable in this name right now, trading at, say, 12.5 times forward earnings, and that expectations for the name were, well, they're set really low heading into this report. So I'm not really surprised that we're gaining a quick exuberance in the stock price of 14%, because as their previous earnings reports have shown, this stock right now is being led by short-term holders in the name, and they're the ones moving the stock right now. The long onlys are not playing right now. So I think that if you're a short-term investor, you saw some benefit from margins, so I'm not too surprised by the move in the stock.
David,
no,
how is Target positioned going into what is going to be a highly promotional and what is actually based on some of the deals that they've already put out there and many of the other retailers too? How are they positioned in the midst of a highly promotional season that's going to impact margins?
Well, I think that's actually one of the bigger drivers of what my merchandise gross margin increased from like 24.7% this quarter last year to 27.4% this year. So it came off much better than expected. But, I'm not solely focusing on that part because, inventory has been a problem for them for quite some time. It's actually what I'm focusing on, Brad, is what you brought up before. It's the grocery side of the mix. I love comparing Target to Walmart. Yeah, Target's a big player in the grocery side of the business. They get about 30% of their revenue from that aspect. But if you look at Walmart, they generate about closer to 60%. And we know that people aren't spending any type of money on any type of big ticket or any type of home improvement right now. They're spending a lot of their time on buying staples, buying that beauty you were alluding to before. And that's more of my focus there than some of the benefits from the problems of last year's inventory.
David, how are you looking at the threat of theft and what we've seen play out within so many of these retailers? Obviously, it's a problem across the industry, but in Target's earnings, it still shows that theft, they're still struggling with exactly the challenges and the impact that they're seeing from it.
I just don't know how this stops. It's pretty binary to me or not. Is shrink continuing to happen or it's not continuing to happen? It's been, 4 quarters in a row, the company's blaming their margins on increased shrink. And as I told you before, that was the second largest aspect I was really focusing on this earnings report is, what is the commentary around shrink? Has it plateaued? We know they closed 9 stores over the last quarter, but from the commentary from Brian Cornwall on the earnings call here, it just doesn't seem like it's slowing down right now for them.
And so when we think about ultimately going forward from this point in the retail environment, what do you need to hear from Target on this earnings call that would signal to them or to signal to investors, even though we're seeing shares sent higher by about 14% here pre-market, that would signal to investors that this is a company that not only has a handle on shrink, a handle on the grocery aisle, but also a handle on when they could start to repurchase shares too, because that was something in the quarter that came out as well. They didn't repurchase any stock, even though they have plenty of kind of fuel in, or at least what they've communicated to the street, they're willing to and anticipating to purchase.
Well, if they, I think that should be pretty normal blocking and tackling if they should be buying back their shares at 12.5 times earning. That's like 2 standard deviations below their historical average, even if you take out the 2014 spike and the COVID spike right there. I think it, Brad, it comes all down to balanced top line growth. That's what the street needs to see for the long onlys to get really back into this name. One of the biggest problems that they've had is they've kind of lost their brand recognition as the go-to retailer. And if they can't get that back, well, one, they're not going to get their historical valuation that they've gotten, which is closer to 16 times. They could remain around that 13 to 14.5 times that they're trading right now. But if they don't get that brand recognition back, I think that the market's going to have to see some type of signal from the board that Brian Cornwall, well, he's probably got to go.
He's got to go?
Yeah. Get him out of here.
So right now, I guess, So that's a lot to unpack. I wanted to bring up TJX, so let's stick with what you just said about Brian there. If we do, in fact, do you think that that's something that's going to, I guess, gain momentum here if we don't see that turnaround? And I guess if you're already saying now he needs to go, is there someone within Target, or who do you think should then potentially replace him?
I don't think it's something that should happen this quarter. I mean, obviously blocking and tackling, on the board regarding buyback should happen. But, what is the name recognition here in the retailer space on the brand side? For the longest decade, it's been Target. I mean, that's why they got such a valuation re-rating, at the earlier part of the 2010 decade. Like, everywhere you read on any type of meme, go into Target, try to spend $20, you come out spending basically $2,000. But that really just hasn't been the case. They've lost some of their clientele. They've made some wrong steps from the vision of their marketing side. And if they can't get that top line growth back and make sure that, consumers understand that they are the brand retailer that they were 10 years ago, I think that Brian Cornwell, he should be on the hot seat.
All right, David, quickly, let's get to TJX here because we're seeing some movement on the heels of these results. When you take a look at the comp sales that the company did report here, showing that home goods comp sales, they were up 9% compared to a drop of 16% just about a year ago. Taking a look at TJ Maxx, their comp sales also coming in better than expected. What does that tell us just about how some of these discount retailers are positioned at this point in the economic cycle?
You're exactly right. This is becoming a trade down story. That's why you have TJ Maxx valuation of 23.5 times earnings, and you got more of a Target, which obviously has more exposure to big ticket items, at trading at 12.5 times forward earnings right now. I mean, I really legitimately look back at this earnings report. On its first glance, it was an awesome report. They beat on sales, they beat on earnings, they raised guidance on stronger comps driven by, increased traffic. And then, they're also increasing their market share. Then I looked at, the report again, and it was actually even better than what I saw really at first glance right now. So this was kind of an awesome report. And it almost seems like it's the market's taking a playbook out of Seinfeld's George Costanza and doing the exact opposite of what they probably should be doing. Because I thought Target's report wasn't great. The stock's up 14%. I thought TJ Maxx report was absolutely awesome, and it's down 2 or 3% right now. So I guess it paid to do the opposite here.
All right, David, we got to leave the conversation there. We appreciate you jumping on with us this morning to break down some of these retail earnings reports. And no doubt next time I'm in Ohio, I'll hit you with my my skin routines that I have for the weekends usually here. David Wagner, who is the Aptus Capital Equity Analyst Portfolio Manager.
Yep.
David, appreciate the time. Also, everyone, Warren Buffett's Berkshire Hathaway has sold its stake in a handful of companies, including General Motors and Johnson & Johnson, and offloading smaller positions in companies like Procter & Gamble, according to its latest 13F filing. Berkshire's top 3 holdings remain Apple, Bank of America, and American Express here. What should be noteworthy about some of the companies that they have offloaded is that they are either in the midst of or have already initiated specific spin-offs. You think about Johnson & Johnson and making sure that the consumer health division is separate from what they're trying to do on the pharmaceutical side. And then you think about as well what GM still has to answer for with regard to this cruise automation business right now that is seeing a plethora of hurdles start to emerge in different states and unfortunately having to halt some of the automotive and autonomous vehicle practices there until they get more answers or are able to show regulators in those jurisdictions that they can move forward safely there. So those are 2 of the larger exits that Berkshire Hathaway has made, perhaps just noticing some of the larger, how these businesses are vastly different than when they took on these positions to begin with.
Yeah, exactly. And also within that group, you can add the exiting the stake of Activision Blizzard as well, obviously following the fact that they did sell to Microsoft. When it comes to some of the, patterns that we're starting to see from Warren Buffett, from Berkshire Hathaway this year, obviously you can point to the fact that they've been a net seller here of equities, $23.6 billion from stock sales this year. Other changes that they also have made is some of their positioning within the banking sector, within the financial sector. We know that they exited Bancorp and Bank of New York Mellon earlier this year. And then also where he's placing more of an emphasis on, when you take into account the new stake that the company has in Sirius XM Holdings, we're seeing a real reaction in shares there today. The company disclosing that it held 9.68 million shares of share stake in Sirius. So we're seeing a big pop to the upside there. Sirius shares have fallen about 24% in the past year. So making a bet on a beaten down name and really sees some momentum here to the upside going forward. All right, China's Tencent boasted a big recovery in the third quarter as revenue jumped 10% from a year ago to 21 billion, now driven by a rebound in online advertising. The results signal that despite a downturn, Chinese consumers are still turning to social media and gaming. We're seeing a jump of just about nearly 5% here on the news of that. When you take a look at these results, exactly what is showing us here, profit beating expectations. Revenue was essentially, though, in line, showing that the Chinese consumers, they're turning to social media, they're turning to games despite the fact that the economy is still weak. But there are some areas of concern here when you take a look at some of the gross margin, what exactly that could mean then going forward, especially at a time when China obviously remains under pressure. Yes, we are seeing a recovery, but much slower than what we had initially anticipated.
Yeah, you got to think if there's more money in the pockets of the Chinese consumer that is engaging with a lot of the mini games, that kind of that spend in game would continue to increase perhaps. And that's exactly what they pointed to. Relatively new services such as video accounts and mini games contributing to that high margin revenue stream while they refocus away from less scalable activities here. They're also increasing some investment in some of those AI models. Of course, why not? Because the year of AI, it's expected that Tencent is going to be doing something within that regard, and we'll see where some of their end users and then also even the businesses that they continue to engage with, where they perhaps gravitate towards some of those services as they bring them online. Also, everyone, as we mentioned at the top of the show, President Joe Biden and China's Xi Jinping are scheduled to meet later today in San Francisco. This is their first meeting in a year and arguably the most closely watched event of the summit. With China's economy struggling to gain its recovery foothold in 2023, the nation is keen to woo investors, and APEC represents a major opportunity. CEOs at Citigroup, Exxon, Microsoft, and Tesla, they are among those attending the summit this week. Several executives will meet for a dinner Wednesday night, where President Xi will reportedly be the guest of honor. For more on this, we've got Yahoo Finance reporter Akiko Fujita. Akiko, what more do we know about this summit?
Yeah, Brad, this is a meeting that's happening on the sidelines of APEC, and the White House has set the bar pretty low for this first in 1 year meeting between President Xi Jinping and President Biden, saying that this is really about maintaining those open lines of communication and managing competition responsibly. This marks just the second in-person meeting between these two leaders. Last year, it was in Bali, and a lot has changed since that last meeting. Let's talk about the Chinese economy first. That's been dragged down by a crumbling property sector. You've got youth unemployment at record levels, and then growth overall slowing down to levels we have not seen in decades. Add to that ongoing competition between the U.S. and China, and that's led to export controls on advanced chips and restrictions on investments, and that points to a pretty rough environment between these two countries. Now, in addition to that meeting with President Biden, she will be looking to provide assurances to American CEOs at a time when foreign direct investment has turned negative for the first time in history. Some of the biggest names in the corporate sector have descended on San Francisco as part of the APEC CEO summit, and they're looking for face time with the leader. You see some of those names on there: Elon Musk, Satya Nadella, Citigroup's Jane Fraser, Exxon's Darren Woods. You've also got Derek Khosrowshahi from Uber, OpenAI's Sam Altman, and Raj Subramanian from FedEx, as well as GM's Mary Barra. So a pretty lengthy list here. Many of them will be attending a dinner hosted by the U.S.-China Business Council and National Committee on U.S.-China Relations. Now, that guest list has not been confirmed, but the price tag is a pretty hefty one. We're talking about $2,000 a plate for admission into that dinner, and then $40,000 to secure a table with Xi Jinping at the table. President Xi Jinping expected to reassure executives about the Chinese economy and about domestic policy at a time when there's been increasing concerns about the tight controls the Communist Party has placed on private business activity. But it's going to be a pretty tricky dance here for the Chinese president. It's not just about holding court here with American CEOs. It is also about playing to a domestic audience. There have been reports of the Chinese officials flying in supporters of Xi Jinping so that he does project this air of confidence in leadership. So he's going to try to play this very tricky dance here with American CEOs, certainly looking for a little more reassurance given what's been reported out of China in terms of business activity there.
That is one expensive plate there, Akiko. I'm still on that. $2,000, you said a plate, $40,000 for a table?
$40,000 for a table with Xi Jinping there.
Yeah.
That's the price tag that's been reported out.
Yeah, well, we know how critical, obviously, China is for so many of these companies. So put that in account. I guess maybe it's not too pricey. All right, Akiko Fujita, thanks so much. Keep right here on Yahoo Finance. We got all your market action ahead. We'll be right back. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
This week, CEO of JP Morgan Chase, Jamie Dimon, saying that the Fed may need to do more on Bloomberg TV. Now, this coming after CPI data showing that inflation was flat in October, sending stocks rallying yesterday. But are these short-term wins enough to keep rates from hiking? That's a big question. We're all asking what this means for the Fed going forward. Let's break it all down. Josh Lipton joining us here on set. Josh, what does this all tell us about what's ahead?
So you guys know there was a big post-CPI party yesterday on Wall Street. We got that October inflation data. Investors certainly liked what they heard. Consumer prices were flat last month, while you saw core inflation rising at the slowest annual rate since September 2021. And then this morning, more evidence that inflationary pressures are abating with that softer than expected producer prices data. Investors are betting that this is all good news, that Fed head Jay Powell has seen enough, that the Fed will now stay on the sidelines, they think, and that this rate hiking campaign is over. But now here comes JP Morgan CEO Jamie Dimon. He's throwing cold water on this party. He was speaking with Bloomberg TV, talking about the inflation numbers and saying people are overreacting to short-term numbers and they should, in his words, stop doing that. He said inflation, in fact, could prove stickier than we think, and it might not go away that quickly, he said. So what does that mean for the Fed? Dimon saying the Fed is right to pause hikes for now, but they might have to do a little bit more, in his words, and people should be prepared for that possibility. Now, that echoes, remember, what Dimon told us here at Yahoo Finance recently. Take a listen.
Yeah, so I personally think you may have had a sea change. And the sea change was that we've had 20 years plus of lower rates. And now, all of a sudden, it looks to me there's a lot of long-term inflation. So forget monthly numbers and stuff like that. Long-term inflationary effects. A $2 trillion deficit, the largest peacetime deficit ever, the largest peacetime deficit with all-time unemployment lows. But you also have commitments that are being made. You know, the IRA Act, the CHIPS Act, the green economy, we think will eventually cost $4 trillion. I hope it's well spent, though I suspect a lot of it will not be well spent. In Europe, when oil and gas prices went way up, they basically financed it for all consumers and producers. So government, and then we have aging populations, Social Security, Medicare.
There's a lot of concerns.
But there are a lot of things which I say are future inflationary. I don't see anything which is future disinflationary. Now, of course, recession is disinflationary, but I see all these trends, so it may be a sea change, so that, if you go back to the 70s or 80s, rates were higher, they were kind of more volatile, and people didn't, no one looked at a 2% rate like that was normal.
Now, if you look at the CME Fed Watch, which tracks Fed fund futures tied to the Fed's benchmark interest rate, there is virtually no chance of a hike priced in right now. And by next March, investors actually price in rate cuts. So Diamond is out here on his own, but of course that doesn't mean he's wrong. Guys, back to you.
Yeah, indeed. And a ton to continue to track, of course, as we get even more of these readings. This morning, it was all about the consumer, as it has been throughout much of this week, with both retail earnings plus some of the economic data that's come out. And the markets are going to continue to latch on to the bad news is good news environment, because that might mean the Fed is just going to sit on its hands for a little bit longer here. Josh, thanks so much for joining us to break down the comments from the top CEO, or the CEO of the top bank, by market cap here in the U.S. Thanks so much.
Many would say he's the top CEO, too.
Yeah.
All right, we got to get over to the opening bell on Wall Street. We were talking about the gains yesterday. Well, it looks like that momentum is carrying into the open. Jared Blickery standing by with a closer look at what we're watching here. Jared, what do you have? A lot of green on the screen.
Yes, I'm just looking at the sector action. I'll get to the indices in a second, but interesting to see. In the forefront, we have staples, that's consumer staples, up 2/3 of 1%. We also have consumer discretionary, that's XLY, up 0.5%. In between, communication services, which is more of a tech field, but also tech, materials, and financials, all on the top row. We have seen this broad-based rally, and it is really, I'm going to actually put a chart of the S&P 500, then I'm going to show you what the small caps, the Russell 2000, has been doing. Here's the S&P 500 this week. Most of the gains took place yesterday. Pretty impressive 2% here, but take a look at the Russell 2000, up 5.45%, had its best day in quite a long time here, and a welcome relief, because just take a look at the 3-year chart. It has been just trading in this sideways range, and now it has finally bounced off the bottom and perhaps heading back up to the 2000 level. The bond market had a huge day yesterday. Let's see if I can get the 10-year T-note yield up. I think it dropped 17, 18 basis points. That was another huge outsized supporter of risk markets. And here we go. We can see over the last 3 years. Let me just dial this down to a 2-month chart where you can see, we broke below 4.5%. We're climbing a little bit back today, but I think a lot of traders have lower long-term yield targets in mind now that we were able to break that critical support level. Let's take a look at the Nasdaq 100. Lots of action, especially in the mega caps. Nvidia might be looking to break that 10-day winning streak. We'll have to see if it can close in the green. Looks like it just popped in there north of the unchanged. Apple up 0.4%, Microsoft 0.5%, Alphabet right there behind. As far as some outperformers, looks like Pinduoduo over in China up 3%. And let's take a quick look at the ARK Innovation Fund components. We saw a lot of disruption. Stocks gained yesterday, but kind of a mixed bag. Tesla was up 4 or 5% yesterday, off a little bit today. So we'll have to see what the day brings. Let me just close on some of our leaders here, because we have seen a lot of breadth in this market. And when you see everything here, including some of the fringier markets, like gambling, bets up 4.5%, like crypto up 2.5%, that just speaks as to the broadness of this rally. So pretty healthy looking, at least in the early goings here, guys.
All right, Jared Blickery, thanks so much. We'll check in with you in just a little bit. Well, speaking of the gains that we're seeing, the chances of a year-end rally, they're being put to the test. All of the major averages moving higher once again this morning on fresh economic data that we're getting out. A key reading on the consumer, also another key reading on inflation. When it comes to consumer retail sales during the month of October, cooling as consumers pull back on discretionary spending amid a sticky inflation environment. Tech led Tuesday's gains, with the Nasdaq posting its best day that we've seen since April. Now remember, tech led the market in the first half of the year, with the hype surrounding AI, artificial intelligence, fueling that rally. Yahoo Finance's Julie Hyman spoke with ARK Invest CEO Cathie Wood on her positioning toward the AI hype cycle yesterday. Let's take a listen to what she had to say.
Everyone knows Nvidia has been the enabler of these amazing breakthroughs in AI, but they're not thinking about who the prime beneficiaries are going to be. And we've taken a strong point of view on that. Every stock in our portfolio, practically, is there with AI as a reason.
All right, for more on how to play the year-end rally and what to expect looking ahead to 2024, we want to bring in Keith Lerner, Truist Co-Chief Investment Officer. Keith, it's good to see you. So we just heard from Cathie, her perspective on some of the AI leading names that we're seeing in the market today. I know you recently upgraded the tech sector to overweight on a technical basis. What are you seeing?
Yeah, well, first of all, great to be with you, Shona and Brad. Nice to see some green. Market's been doing really well. In fact, we, our view has been more positive the last month or so. And specifically to tech, I do think tech is leadership and will continue to be leadership. When you look at this market, they were leadership earlier this year, and then the technology sector just digested the gains. And what was notable, it was the last sector to go down during the correction, but it also came back the strongest. And we just made, as you mentioned, on a technical basis, a 5-month relative high to the overall market. So what does that tell you? That the old leadership this year is still the new leadership, which is tech. And we think that likely has more legs before the end of the year.
And so does that mean Santa Claus rally full on, Keith?
Yeah, it's hard for me because we wrote a note on October 27th when the market was at 4,100, and the note title was pullback equals opportunity. So now we're up 10%. I can't be as bullish as we were there, and part of the reason was that we were positive then. There's several factors, but you're talking about seasonality. The low in seasonality was the end of October, and then it starts to move higher. So to put a final point on it, we still think there's some more upside from here, but we've just gone up 10%. So we have to be realistic that we've come a long way. I think near term, likely what happens as you get around this 45, 41, which is the high that we saw in the beginning of September, maybe just digest, go back and forth a little bit before another move higher. But I would say if we digest, chop around a little bit, I would be looking at tech as an opportunity to add. And I also think other areas like small caps likely have further to go, which are still only up about 2 or 3% this year.
Yeah, Keith, what do you think that upside looks like for small caps?
I think it could be somewhat larger than it is for large caps. Again, I think technology has definitely shown their leadership, but more from mean reversion. End of the year, we had a lot of tax loss selling. You think about fund companies, that their tax year end is October. So small caps are only up about 3% this year. And I think there will be somewhat of a chase. We saw that yesterday. I think that likely has more to go. So if large caps are up 3 or 4%, maybe small caps can be up 6 or 7. It's hard for me to say an exact number. I would just say probably more on a short-term basis. Ultimately, as we move into next year, we still think large caps are the place to be, but we're recognizing that they're still oversold and haven't done much this year.
And what is that catalyst for large caps once we get into next year from your perspective, Keith?
Yeah, well, listen, I think a couple of things. The catalyst so far this year has been the economy has been more resilient than most expectations, and that earnings have also proven somewhat strong. So I think some of that continues. I do think next year, if we have a strong rally into year end that continues, I think that sets us up for more of choppy waters in the beginning of next year. So I'm not saying we're off to the races, but I do think if you think about technology, that earnings will likely continue to hold up well, because even if the economy slows down from where it's been, companies will likely continue to invest in technology, otherwise risk being left behind as far as from just a corporate competitiveness standpoint.
Keith, you also recently downgraded the energy sector to neutral from overweight. We certainly have seen crude pull back from the highs that we saw not too long ago. What do you think, what's it going to take? Why are you on the sidelines now? And do you see potentially returning to a bull case as you look ahead to 2024?
Yeah, I would think, based on what I know today, we would be more likely to upgrade from neutral than to downgrade to underweight. Of course, we're going to let our process dictate that. But, I think it's one of the things where, part of this, you mentioned we have a quantitative process. The technical trends have softened quite a bit. Energy has pulled back quite a bit. Longer term, they're still relatively cheap. I think the low end of oil prices will be higher than it has been historically. So for someone who's not looking as tactically as we are with our sector strategy, I think energy will be just fine. And this, as we move into next year, there's a lot of geopolitical risk, and even beyond just our own elections as well. So I do think, for someone that has a little bit longer standpoint, that energy is still going to do fine. And like I said, we'll likely look for an opportunity to upgrade that sometime next year.
Yeah, CEOs really already kind of earmarking geopolitical tension, risk as one of their top concerns for growth over the next 3 years. So we'll see how that plays out in the general elections and what more is to come on that front over the course of 2024 too. Keith, always a pleasure to get some of your insights. Thanks for joining us just after the opening bell here in the U.S. Keith Lerner, Truist Co-Chief Investment Officer, and happy birthday.
Thanks, guys. I really
it's your birthday?
That.
Happy birthday, Keith.
I don't know who's telling you guys this inside information, but I certainly appreciate it.
It was the government. The government told us.
Very happy birthday.
Thanks so much,
Thank
Keith.
you.
All right, guys, let's take a look at some individual movers that we're also tracking this morning. Let's jump on over to China. JD.com came out with earnings this morning, posting a stronger than expected beat on revenue as the company leaned on its price competitiveness and operating efficiency. This comes on the back of Singles Day and a heavy promotional campaign that started towards the end of October, with the company saying that it saw transaction volume, order volume, and user engagement reach all-time highs, dubbing the shopping festival a record-breaking event. There you're taking a look at some of the actuals versus the estimates, just to show you that it actually did beat on the top and bottom line there. And I actually didn't know that this company stood for Jingdong. So for anybody wondering what JD stands for, that's it. At the end of the day, though, coming back to these results, they said that they reported this top-line performance for the quarter, record profitability as well, driven by some of the proactive efforts on enhancing price competitiveness. Interesting to hear there. And then additionally, some of the platform ecosystem changes that they've made.
Yeah, I also think it's important to point out that the core retail arm, though that the sales there in that division, it was flat. So yes, when you take into account profitability, did improve, revenue was in line. That seems to be enough for the street right now. But there are some signs here, some data points that I say are a bit concerning when you talk about where the Chinese consumer is now and what that could potentially portend here in the months ahead. Revenue collected from third-party merchants increasing by just 3%, the lowest rate on record. We also know that their electronic sales as well as marketplace advertising revenues were a bit softer than initially anticipated. So there are some reasons to be a bit cautious when it comes to this report. And I think it also just shows some of the challenges that are facing JD.com specifically amid the broader economic landscape right now, but also amid increased competition. We know that's something that JD.com has weighed on JD.com shares more recently and will likely continue to do so as they try to figure out, navigate what is likely going to be a pretty tough time here for the company.
Yeah, absolutely. Continuing to watch those shares as well as some of the other major players in that region.
Yeah, so let's take a look at another major player that we are keeping an eye on this morning. XPeng, the AV maker, reporting mixed numbers when it saw new vehicle sales jump. XPeng nearly doubling its revenue forecast for the final quarter of 2023, but investors are still worried about the flagging interest in hybrid and EVs. Now, this is a story we've been talking about now for quite some time when it comes to some of the challenges facing the broader EV sector, but specifically on these results, a wider than expected loss, negative gross margin still, decline of 2.7%. Yes, it was an improvement from negative 3.9% in the previous quarter, but still negative gross margins, obviously a bit worrisome here for investors. And also it's struggling with increased competition as well. We were just talking about JD.com, increased competition within that space. We know the EV space obviously has been very much influenced by some of the newer arrivals of some of the newer vehicles within that space. We know Tesla has been aggressively slashing prices, which has also sparked a price war playing out right now in China. And that, of course, pressuring margins even more.
Yeah, you hit the nail on the head here. You look at the margins here. For the gross margin, it was negative 2.7%. Cyclically, or at least kind of looking based on or versus the last year, third quarter of 2023, compared with 13.5% for the same period, 2022. So that is kind of the marker to pair it up against. So significant decline year over year, but sequentially, quarter over quarter, you did see some slight improvement, but in the previous quarter, it was down by about 3.9%. But again, that comes back to that pricing war, the pricing pressures that these companies are going to continue to have to wade through, of course, as more of the companies are changing exactly what that price point is to get their vehicles into market.
And XPeng also doesn't expect to post a profit until 2025. All right, keep right here on Yahoo Finance. We got all your market action ahead. We'll be right back.
Big box retailers have made a lot of moves in the last year, but a decade ago, there were some major players that vanished. Circuit City was one of them. It was a big name in the mass marketing of televisions, refrigerators, and this thing called the boom box, and a couple CD players as well. It had over 1,500 stores with over 40,000 workers, and then it went bankrupt. Now, it's looking for a comeback, initiating a Series A funding round and a strategy no longer focused on brick and mortar specifically there. We're joined now by Ronnie Schmoll, who is the Circuit City CEO. Ronnie, great to grab some time with you here. I think as all of us saw this announcement come across yesterday, we all got a big dose of nostalgia, and a lot of people perhaps wondering, when we've got the electronics and appliance sales still seeking a trough, why now for Circuit City to make this comeback?
It's a great question, Brad. Thank you for having me. The reason why we decided to come to the market at this time is because retail as a whole has been slumped over the last 10 years or so. We have found a lot of opportunity with existing retailers to actually help them. We actually just launched a pilot with JCPenney. So we are actually now in 288 JCPenney stores. And customers could also find us on the JCPenney website. So we're leveraging the brand awareness as well. So we're leveraging the brand awareness, the products curated event that we're having now on JCPenney, and customers now will be able to find products that actually match their needs and solutions.
Ronnie, talk to us a little bit about those partnerships. You mentioned the partnership now that you have with JCPenney. When you're out there trying to make these deals, what brands, what names make the most sense when you're trying to reinvent Circuit City's story?
It's a great question. So we have an ecosystem of a platform that enables us to match the right products and brands to the right retailer. So it's pretty much an AI-driven platform that we've designed over the last 3 years. And in our product database, we have over 1 million products. And each specific retailer has a different customer demographic, different price points, even by geography. So it's really, I think, revolutionary to the market. And we're really trying to find the right products and brands to each retailer.
Now, when you think about scaling, what type of financial performance do you need to see in these early moments to hit the ramp plans that you have for 2024?
Great question. So over the last 5 years since inception, since launch, we started out with our first pillar, which is e-commerce, direct to consumer. We've actually hit our milestones. We've been profitable since day one. So that was a great indication and demonstration of where we need to go and how far we need to scale and grow. Our second pillar that we launched was B2B e-commerce in 2019. And since that time, we've grown year over year in the B2B e-commerce sector. Our third pillar is our newest and latest one, which is called Powered by Circuit City. And this is Powered by Circuit City is exactly as it's described, where we're actually placed in another retailer's either online or offline in their brick and mortar stores. And so far, so good. We've been doing great, hitting our milestones. And we really look, even though the market itself as a whole is a little, I guess, softer, as expected, what's going on with the economy, we're actually doing quite well in where we are.
Ronnie, what do you attribute that to then? Because we've seen so many brands, so many names within the retail space right now, obviously struggling with the fact that consumers simply aren't spending on many of these discretionary purchases.
It's a great question. We've stuck to products, our core products that people really need on an everyday basis. So what has happened in COVID is the evolution of work from home. So people are still buying products for home, office, and they may not be buying the most expensive product out there, but they are still buying products and solutions that they need, especially in the B2B sector. We're finding that businesses are stickier. They're buying products that, you can't really slow down a business if you need a new printer, laptop, and so on and so forth. So we are finding a lot of value in those categories and areas where people are buying, where it's more of a necessity rather than, something that they may like or want and wait for it when they feel they could spend more money. So, I mean, look, technology products, I mean, it's in our lives every day. So people are just buying products as we are pretty much relying on all these products, our phones, our laptops. So we're not really finding a slowdown. We're not at our peak as Circuit City was. So for us, any incremental sales that we do get shows growth on our side. So we're content, we're happy, and we're striving to keep on moving the wheel and pushing out there.
Ronnie, this has, in some senses, been the year of the brand reboot, where even though you had Bed Bath & Beyond go bankrupt, the IP got purchased, and now for Overstock and the kind of marriage that's taken place there, and now rebranding or reinitiation or reboot of Bed Bath & Beyond, consumers have seen that come forward. I've been seeing more old Reebok shoes that I bought back in grade school coming back now after that purchase. You've got Toys R Us that's opening in Mall of America as well. So all this considered, what is vastly different about the retail environment right now versus when many of these companies, yourself included, were seeing the heyday?
It's a great question. The essence of the brand is the awareness of the brand. It's the trust. It's the nostalgic component to it as well. People know the brands, and there's a reason why there's an emergence of these big brands, these heritage brands, these iconic brands that are making service back in the market over the last 10 to 15 years. The key to success is to look at the market, see where the opportunities are, and not relaunch the same iteration of these brands. So Overstock did something I think genius. They rebranded their whole company under Bed Bath & Beyond now. So it's a completely digital model. Circuit City today is a technology e-commerce play only, digital. We're not going to open up our own brick and mortar retail. There's no plans for that. So what we're doing is we built out a plan and strategy based on e-commerce marketplace technology, and we coupled it with using the catalyst of Circuit City for the brand awareness component.
Ronnie Schmull, we appreciate you taking the time. We wish you all the best and hope to have you back here on Yahoo Finance. Ronnie Schmull, the CEO of Circuit City.
Take care. Thank you so much.
Well, coming up next, lawmakers are closing in on a deal to avoid a government shutdown, but with days until that deadline, what's the vibe in Washington? We've got more on that next. Shutdown averted. Well, almost. House lawmakers have passed the Republicans' plan to fund the government through early next year. The vote at 336 to 95, just ahead of Friday's deadline. Now, the vote was largely carried by Democrats as Republicans remain divided over government spending levels. The deal now heads to the Senate, which is widely expected to pass the legislation. We have heard from Democratic leadership within the Senate that they do largely support this bill and passing this bill. When it comes to what is included in this measure, it pretty much extends the funding at current levels right now, pushing out some of those more contentious fights, more contentious issues when it comes to border security, when it comes to federal spending levels, Ukraine funding. So yes, this will help us avoid a government shutdown at the end of this week. But really, once again, just kicking the can down the road until we address some of those more sticky issues, and many of those issues being why we're in this place right now.
Yeah, laddered continuing resolution. We told our viewers at the beginning of the week that they were going to get a crash course in exactly what that meant, and that's exactly what we got. And ultimately, January 19th and now I think February 2nd are going to be the two dates that we have to continue to look at once we get into 2024. But you notice what is taking place within the Beltway now. Mike Johnson, the majority leader in the House, at least, he is trying to assuage many of the congressional members that he can reach across party lines and get a deal done. However, that might come at a risk of upsetting some of the people who previously voted out former House Speaker Kevin McCarthy. So that is something that's going to be interesting to continue to watch play out as well as part of this more broadly.
Yeah, and Johnson saying yesterday that he believes that he can fight on principle and do these things simultaneously. When you have a small majority, it requires some things are going to have to be bipartisan. So we'll see what the House is able to push forward here as we look ahead to 2024. All right, we'll keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
10 a.m. in New York, I'm Brad Smith alongside Shauna Smith live in New York City, the aforementioned. We are about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. The major averages are extending their gains this morning as cooling producer prices and consumer spending signal good news for the Fed.
And taking a look at some of those individual movers, American Express today named the best card issuer by Barclays. Now, analyst Terry Ma initiating coverage on the stock with an overweight rating and $184 price target. That implies pretty significant upside to where the stock is currently trading at $158.
And Advanced Auto Parts is attempting to drive up profitability with a $150 million cost savings plan as the company reports a surprise loss in its third quarter. The company also announced its decision to initiate the sale of Worldpac as well as its Canadian business in order to have a more focused business model.
And good news for Goodyear, the tire company making several announcements today that boosted investor sentiment. First, longtime CEO Richard Kramer intends to retire next year after spending more than a decade in the position. Now, the company is also exploring strategic alternatives for its chemical business, its Dunlop brand, and its off-the-road equipment tire business in an effort to raise over $2 billion in proceeds. You're looking at gains of just over 2%.
Well, guess who's back again? China's President Xi Jinping is back in the United States for the first time since 2017. He is in San Francisco for the Asia-Pacific Economic Cooperation Leaders Summit, also known as APEC. Xi will meet with President Biden at 2 p.m. today, and the two haven't spoken in person since they met in Indonesia a year ago at the G20 summit, and the U.S.-China relationship has been rocky ever since. Our next guest says she's tracking 3 key things from the meeting: fentanyl, military communication, and regional wars. Joining us now, we've got Zoe Liu, who is the Council on Foreign Relations International Political Economy Fellow and author of Sovereign Funds. Okay, great to have you back here with us on the show, Zoe. First and foremost, we got to know, of those 3 big items that you've laid out that you're watching, which takes the cake as the top?
Now, hi, Brad and Shauna. Thank you very much for having me. From where I stand, I would view military-to-military dialogue mechanism restoration as first and foremost priority, in the sense that since Nancy Pelosi's tour of Taiwan, the United States and China does not or hasn't been able to communicate military to military. And on top of that, China now does not even have a defense minister. So that not only worries me, but also worries our allies in the region.
So when it comes to any significant progress that you're expecting to be made, because yes, the priorities, maybe the message is similar here just in terms of what they're hoping to see, progress in the relationship from both sides, but the priorities are very different. So how does what Biden prioritizes compare to what will likely be priorities from Xi, and whether or not we could expect any significant progress on any of those issues?
Shauna, you're right. I do think that the priorities of President Biden and President Xi Jinping are very different. Viewing from President Biden's perspective, perhaps restoring, he is having less a pressure compared with President Xi Jinping in terms of managing or restoring U.S.-China relations to the pre-Trump era, specifically because, on the one hand, he is having an election next year, and then on the other hand, the U.S. economy and economic growth trajectory is on a much stronger momentum and footing compared with that of China. Whereas from the point of President Xi Jinping, his top priority perhaps is to show to China's domestic audience that he is able to manage the geopolitical tension with the United States. So from that perspective, for President Xi Jinping, injecting a confidence to the Chinese economy is his first priority, whereas for President Biden, this is not necessarily the case. He probably would prioritize issues that matter a lot for American interests, such as fentanyl, such as issues related to strengthening America's national security issues, preserving export controls and investment screening.
Zoe, does management of the U.S.-China relationship from Xi Jinping's standpoint also mean potential removal of some of the tariffs that have been on the table now, have not been removed since the tit-for-tat trade war that took place during a previous administration here that both of these gentlemen now have to continue to wade through and ultimately decide, okay, what is going to be the thing that tips the scale and brings some of that off of the table?
Brad, that is an excellent point. In a way, the Trump era tariff sort of continued. And when Biden first came into office, the Chinese officials thought that it was the perfect time to reset U.S.-China relations. And guess what? The reset did not happen as anticipated. And with regard to what extent tariff can or cannot be removed, I do not necessarily think this is the time. Part of the reason is because domestic politics, specifically here, we are having an election next year. This is probably not the politically correct time to discuss that. And then on the other hand, despite that, removing tariff or lowering that is not necessarily an option, China already shows, news stories already leaked that China is probably going to agree on buying additional soybeans and remove the ban on purchasing Boeing airplanes. So those could sort of like compensate the lack of removal of tariffs.
Zoe, when you take into account the business confidence hitting a low here in China, U.S. business confidence hitting a low, we know a number of CEOs are going to be attending the summit, some potentially attending a dinner tonight with China's President Xi Jinping. What do you think these business leaders want to hear from President Xi? And is he going to be able to help restore some of that lost confidence?
If I were a business CEO, I would want to hear that first and foremost, my investment is welcomed. And then secondly, I'm not going to be forced to transfer my intellectual property. And thirdly, there is not going to be, exit bans. I want something concrete, right? However, that's not necessarily President Xi Jinping. That's not necessarily the kind of concrete message that President Xi Jinping is necessarily going to promise. But he probably would focus the attention on re-injecting a sense of stability and predictability to American business executives for the sectors such as energy, high tech, and financial services industry. These are the three sectors that the government actually prioritize. And more specifically, the Chinese economy right now is suffering from a lack of confidence, both domestically and internationally. So hopefully through this dinner with President Xi Jinping, instead of thinking about when and how fast business should pull out of China, maybe this is an opportunity to reevaluate what are the sectors that we can go into.
We'll wait to see what we hear tonight and over the coming days from these meetings. All right, Zoe Liu, always great to get your perspective. Counsel on Foreign Relations, International Political Economy, a fellow. Thanks so much, Zoe.
Thank you for having me.
Keep right here on Yahoo Finance. We got all your market action ahead. We'll be right back.
Welcome back to Yahoo Finance Live. I'm senior health reporter Anjali Kemlani. The importance of clean air came to the fore in the aftermath of the COVID-19 pandemic. Proper ventilation continues to be a key way to reduce the risk of catching the deadly virus. Earlier this year, the CDC updated its ventilation guidance, explicitly setting a target for the first time. But respiratory risks extend beyond COVID-19 to the impact from wildfires, for those suffering with asthma and heart disease, and the heightened risks of catching tuberculosis, TB. So what precautions are governments and corporations taking? And where does it leave the general public? That's a question I'm going to turn and ask Joseph G. Allen, Associate Professor, Director at the Harvard T.H. Chan School of Public Health and Harvard Healthy Buildings Program. This is literally your life, Joe. Tell me about it right now. We know that the pandemic opened up this discussion. Are enough people taking it seriously?
Well, thanks for having me on first. And I think people are starting to pay attention to it. And this was not the case before the pandemic, but people finally woke up to the reality that the way we manage our buildings, including air quality in spaces like this, determines how healthy we are. And I don't just mean protection against COVID, as you said, but also against other respiratory pathogens, influenza, RSV, and also just making us feel good and more productive, and actually helps our cognitive function. So there's lots of ways that the indoor air influences our health and performance, and most people just really weren't paying attention to it, but that's changing quickly.
Yeah, I know that one of the things that became really popular during the pandemic was those CO2 monitors, making sure you're walking around, understanding particles per meter. Is that what it is?
Well, yeah, for carbon dioxide, we measure as an indicator for ventilation. We emit carbon dioxide. You can measure particles, PM 2.5, that's outdoor air pollution that penetrates inside. But you're right, these new low-cost sensors are allowing people to see for the first time what's actually happening. You can't really tell what's happening in a space like this unless you're monitoring it. And I wrote about this in Harvard Business Review just last week, trying to raise awareness about these new tools that are available for businesses and individuals, employees. They can actually sense in real time what's happening in their space because you can't see what's happening.
Right, and I know that you helped advise Amazon on their new HQ2 down in Virginia, setting up a really intricate system of pipes and real-time monitoring that helped during the recent wildfire. So is that essentially the goal that businesses have to look at, to be setting up these kinds of systems?
Yeah, this is what's coming. And let's be clear, COVID changed and created some fundamental shifts in terms of awareness of what's happening and the need to make sure you're taking care of your buildings. Not surprising, a company like Amazon that's always ahead is leading the market in this space. They deployed, and we helped them deploy air quality monitors across their entire global commercial real estate portfolio.
Wow.
So they're monitoring it everywhere, and the classic business maxim, you manage what you measure. And so it allows them to see their buildings are performing great, and then if anything is off spec, you can go and take corrective action before it's an actual problem.
And some people might say, well, this is just a COVID problem. It's in the past. Wildfires, not such a big deal in this area. What would you say to that? What are the risks that we're facing?
Well, look, we've been in the sick building era for 40 years because we've designed our buildings without health-based targets. And that era is over, and there are these fundamental shifts I was talking about. First, the medical community and medical literature is being rewritten about airborne transmission of these viruses. That's leading to permanent changes into how we design our buildings, and it's changing code. You mentioned CDC. First time ever in their history, they set a health-based target. That's a 40-year correction. On top of that, major awareness changes. The public is talking about this. Employees are asking about it. You have low-cost sensors as technology changes. So all these shifts are playing. This movement is on. And what I wrote about in Harvard Business Review is that the era of head in the sand is over. Right? You can't just say, well, yeah, we took care of air quality in here. Well, you can be called on that because people have access to these relatively low-cost sensors, and they'll tell you when you're underperforming. And in fact, they're doing that and sharing it on social media, shaming many companies, in fact, who aren't doing the right thing in their buildings.
Well, we're also in an era of sort of flexible and hybrid work, right? People are choosing to work at home. What are steps that someone can take at home to ensure that their environment is safe?
Yeah, similar things we talk about in buildings. We're just talking about bringing in a little bit more outdoor air. And if that air is dirty or if there's bad outdoor air pollution, just from normal outdoor air pollution or during a wildfire event, you can increase the level of filtration in your space. That can be a portable device with a HEPA filter, or if you have a mechanical system, you just upgrade your level of filtration. So there's a couple easy steps, and the reason we have to do it is because we've designed our buildings, honestly, the wrong way for a long time. We've ignored a lot of this great science that tells us when we bring in more outdoor air, clean that air through good filtration. We reduce the risk of transmission of COVID and everything else. And we provide a benefit in terms of better cognitive function, less worker absenteeism. Students perform better on math tests and reading tests. So the list goes on in terms of all the benefits when we make these improvements to our buildings.
And certainly, we're in New York City. We know affordable housing and older buildings have long been problematic, but certainly a new era, as you said. So hopefully we'll see some changes to that. Joseph G. Allen, thank you so much for joining us today.
Thanks for having me.
And stay tuned, we'll be discussing mental health this afternoon. Over 50 million Americans are battling some form of it. Yahoo Finance's Healthcare Week continues. Don't miss it. Meanwhile, stocks are extending yesterday's rally today after strong earnings from Target signaled signs of a resilient consumer. And October wholesale prices saw the largest monthly decline in over 2 years. Yahoo Finance's Jared Blickery joins us now with the latest market action. Jared?
Thank you, Anj. Just taking a look at the indices, Russell 2000 second day is the leader, is up over 5% yesterday, up 0.8%. Compare that to the S&P 500, about half that, 0.4%. Nasdaq, same league there, and also the Dow, all three of the majors basically in the same territory. But I also want to take a look at the bond market. That's kind of informing some of the sector action that we're seeing today. Big bounce back in the 10-year T-note. That is up 10 basis points, but that is after sinking about 17 or 18 basis points yesterday. Here's the 3-day look. You can see we're still down to about 4.54%, but just a couple days ago, we were considerably higher. Here's a 3-month look coming off that 5% level. Now let's take a look at some heat maps. We have overwhelmingly green price action today. All 11 large cap sectors in the green here. And we do have real estate up over 1%. So is utilities. Both of those are defensive and interest rate sensitive sectors, followed by materials, consumer staples, industrials, and financials. All of those outperforming there. Only tech and healthcare are underperforming, but you can see both of those in the green. Taking a quick look at some of our leaders, KWEB, the Chinese Internet ETF, that is up the most, 3.6%, followed by ARK, and then retail, and then crypto, and also tanning. No, that is actually solar activity. But let's take a look at retail, because we did get some huge earnings today. Target up 17.8%, best day since 2019. Let me just show you that 5-year chart right here. You can see a long way to go before clawing back some of the losses, but I guess you could say that's a good start here. TJX, another big mover, that's down 3.8% off of its earnings. Want to take a look at the travel sector. Noticed a lot of activity here earlier. Airbnb up 2.5%, but take a look at some of the cruise lines. Carnival up 4.6%, Expedia up 6.6%, United up 3.3%. So the travel sector really jumping today. And then want to close this out with a look at the EV sector. This was something that was jumping yesterday, but it looks like Tesla not quite up to yesterday's performance. Look at that. It is up 2% now. Last time I checked, quite a bit lower, but let's take a look at the 3-day performance as it is Wednesday, and you can see up 12.8% over this time period. So one of the leaders this week when you consider the cumulative price action, guys. All your markets straight ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
We are just over a week away from one of the biggest shopping days of the year, Black Friday. Now, the critical holiday shopping season kicking off amid a challenging time for the freight market, with some industry trackers saying that we are in the midst of a freight recession. Demand for freight is often used as an indicator for consumer spending. So what can we expect this holiday season? Let's bring in someone who knows a thing or two about how much consumers are ordering right now. We have Mike Parra. He's the CEO of DHL Express of the Americas. Mike, it's good to see you. So some industry trackers are saying that the freight market is in a recession. What are you seeing on your network demand-wise?
Good morning, and thanks for having us again, Shauna. What I would say is we remain ready for the what ifs. And for that, I mean, there's still some uncertainty that's out there, but we're well positioned to support the growth opportunities. As an example, we're starting to see some growth out of China. And as a result of that, we've had to put up additional capacity in the market, specifically out of southern China and Hong Kong.
And so what does that mean in terms of some of the investments that you're planning to make in that region as even more of that demand comes online?
Yeah, I got to be honest with you, we were quite surprised at the jump. What we are seeing is a phenomenon where, and what we heard this from our customers in conversation with them in what we call our peak readiness plan, is they started to do early sales. And they wanted to smooth out the peak season and the lead up and run up into Black Friday and Cyber Monday. So as a result of that, again, we had to put up additional capacity, which has been good for us.
Mike, how do you think the levels of this year in terms of demand, consumer shipments, how that's going to compare to what we've seen over the last 2 or 3 years?
Yeah, I mean, if you take a look at, for us, since February, we've seen growth out of China. It's been about plus 30% into the U.S. And what we're forecasting for peak season is 14% higher on a peak day of December 11th of somewhere between 16 to 20%. And this is specifically into the United States. From a Black Friday perspective, we're looking at somewhere in the neighborhood of 8 to 10%. And then Cyber Monday, which includes the weekend, we would see something in the neighborhood of 18% versus last year. So there is some, in general, we are seeing the growth. And some of it could be as a result as well as, China, everybody says, well, there's China plus one. And we believe in China plus one because we're seeing it. We're seeing it in northern Mexico, as an example, whether you call it omnishoring, nearshoring, friendshoring across the border, more specifically northern Mexico, Ciudad Juárez, Guadalajara, Monterrey. We're seeing growth from that perspective, but it's not gonna supplant the growth that we'll continue to see not only today but in the future out of China.
And why do you think that is? Just in terms of, is it cost? Is it flexibility of their networks? I guess, why do you see us still relying heavily on China?
Well, I think it's very hard to replace years and years of what they've built up, not only from an employment standpoint, from an overall cost of infrastructure standpoint as well. But again, we are seeing the tendencies of growth outside of it. We talked about Mexico, but we've seen the growth as well out of India, Japan, Hong Kong. We're seeing growth out of Vietnam as well. So the decoupling is slowly happening, but I don't ever believe that we'll see a replacement for the goods that we are receiving out of southern China and even out of Hong Kong.
Mike, more broadly, as you think about your logistics footprint, I mean, we've had the year of negotiations, especially within transportation, especially within even the entertainment space. And it sounds like Starbucks, I don't know what's going to take place there. Ultimately, at the end of the day, what are you hearing from some of your employees that are boots on the ground, that are making these deliveries, that are showing up rain, snow, sleet, and ensuring that the logistical network that DHL has been able to put together continues to run on a day in, day out basis?
Yeah, I mean, we've been blessed, I would say, over the last 6 years. If you take a look at, there's a company called Great Place to Work, based out of San Francisco, and we have been Great Place to Work ranked #1 globally. So we have focused quite heavily on making sure that our employees feel safe when they come to work, that they feel heard and seen, included from that perspective, and then overall, our remuneration packages for them have been consistently above market standards. So our employees in general are quite happy. We continue to make appropriate investment in facilities. An example is the Atlanta hub that we built this year and inaugurated, an $85 million investment in time for peak season. And we knew about the importance of leveraging a key location and a key airport like Atlanta, Hartsfield, Jackson. So the employees are seeing the investments that we're making. We're still making capital expenditure investments in the well-being of our facilities and their safety, and at the same time introducing automation into the process as well.
Thanks so much for joining us, Mike Parra. We know this is a busy time for you and the team. All the best to you, and hope to check back in on the other side. CEO of DHL Express of the Americas, Mike Parra. Appreciate it.
Thank you, Brad. Thank you.
Absolutely. Well, a landmark contract deal that was struck between the UAW and its Detroit Big Three automakers last month could be under threat. Workers at 3 GM plants have voted it down already, and it seems like there are a few more that might be attempting the same. Joining us now for the latest, we've got Yahoo Finance's Pras Subramanian. Pras, you and I have been going back and forth over Slack just about where some of these plants are, how significant they are. Flint seems to be one of the ones that is also in focus here. What do we know so far?
Yeah, so Brad, look, this is all happening in real time. We already had a bunch of this stuff earlier this week with Flint, Delta Township in Lansing, and then also, I believe here, let me just, Spring Hill Assembly in Tennessee. Those are the three big plants that confirmed voted against the deal. And prior to the new news today, which I'm going to get into, the overall deal at GM was still going to pass by a 52% margin, right? So we have more plants to come. So now we hear GM's Wentzville plant. We're hearing about the Corvette Bowling Green, Kentucky plant, and maybe another Buick one that are also voted against. We're still tracking that. Wentzville confirmed. We're still looking at that. And apparently others are reporting now that if you include those plants and those numbers, the deal is actually a slim majority not to go through. Again, we are still calculating that from the UAW site. As of right now, that site, there's a tracker that it's updating in real time. The numbers are a little bit behind from what we're seeing from local chapters reporting on their Facebook pages, for instance, the actual vote tally. So we're seeing that slowly trickle out on the UAW page. So kind of a concern here for GM for sure, because right now Ford and Stellantis are tracking to actually get their deals approved. I've been doing some sort of poking around, and people at GM plants are sort of upset. Why are they voting against deal? They're upset that some of the older workers, the veteran workers, are not getting the benefits that the newer workers are now going to get if that deal goes through. And also, a lot of them are older workers are concerned about defined pension plans and why they didn't get that. So there are some rankling. There's some upset workers there. We'll see what happens as the votes come through. A lot of big plants still coming up, but yes, in real time, this is happening. Not looking that good for GM at the moment.
Pras, if it doesn't get passed by the GM union workers, what happens then?
So I reached out to the UAW about that, and a source told me that what basically happens is that they have to decide what they're going to do. Are they going to actually maintain the pattern agreement, as they call it, within that they've also had with Ford and Stellantis, or they could call another strike? They could also start negotiating again. It's all sort of up in the air as to what they could do, but the potential for another strike is there if all the workers, now it has to be all the workers vote, and even a slim majority, 51% say they want the deal, and the deal passes and they go to work. But if it's below that, then all options are on the table, including a strike.
And so what is the setup for some of the other automakers and their votes that are set to take place as well, Pras?
Well, as of this morning, Ford workers were passing that. Ford UAW members were approving the deal by 66.1% vote, and Stellantis workers were approving it by 79.7% vote. So those look pretty healthy in terms of margins for passage. Again, those are still, we're still midway in the process. We're not totally there yet. Ford workers are, I think, probably the most closest to fully voting. I think by the 17th or end of this week, they'll be done voting. Stellantis and GM have a ways to go. So we'll see what happens. But right now, GM looking the most unlikely to see passage of that tentative agreement.
All right, we will keep close track of these votes as they are tallied. Pras Subramanian, thanks so much. We'll keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned. Thomson Reuters has secured itself as a trusted source for data and information across the legal, accounting, and news media industries. Now, the company is unveiling a generative AI strategy with plans to invest more than $100 million in the technology each year. Thomson Reuters will use the funding to integrate AI into its products, also leverage existing partnerships, and train and educate its 26,000-person workforce in AI. For more on this, I want to bring in Steve Hasker. He's the CEO of Thomson Reuters. Steve, it's good to see you here. So certainly you're placing a priority, putting more emphasis on AI and exactly what that means for your business. But I'm curious how you see AI revolutionizing or how you see it changing your industry here going forward.
Yeah, thanks, Shauna. Thanks for the opportunity. So if I think back over the course of my career, we've had a number of seismic tech disruptions. So we had the advent of the internet, of mobile, social, cloud. And we think that for professionals, so the professionals we serve are lawyers, tax accounting, risk professionals, news professionals, we think generative AI particularly is going to be as big or bigger in terms of its transformative impacts on those professions. So specifically, there will be tasks that are done today by human beings that will be automated, that will be performed by machines, particularly some of the tasks that professionals don't like to do, the routine, sort of repetitive, mundane stuff, firstly. Secondly, we think that that's going to free up professionals to provide more value-added advice. And so it's going to put a premium on their network, the relationships, the ability to interact with other human beings to provide truly sort of differentiated advice and help to their customers. So we think the next few years are going to be quite disrupted, but very, very transformative in terms of those professions.
And Steve, in the past when we've discussed this investment with you before, you've talked about how it could be used in terms of the Microsoft Copilot at that point that you were integrating into your Thomson Reuters services in certain modules and services there, how it would help in content production, how it would help draw up contracts in some cases even. And so how do you ensure that whenever you introduce some new type of generative AI experience or kind of framework or module that goes out to your customers, how that doesn't cannibalize other parts of the business that are already in existence?
Yeah, I mean, we view it, Brad, as additive. We're not naive. We think that there'll be places where there is sort of time spent by human beings that will be replicated by or replaced by machines. But ultimately, one of the sort of the lines I have for our folks here is, particularly those who are nervous about what might happen to their jobs as a result of AI, say, look, you're not going to be replaced by AI, but you might be replaced by another professional who's using AI. So in other words, we all need to become comfortable. We think as a business at Thomson Reuters, this will accelerate our growth because it's going to enable us to play a bigger, broader, deeper role in helping our customers navigate increasing complexity around compliance. So whether that's legal compliance with all the rules and regulations, whether it's tax and accounting compliance, whether it's risk or ESG related compliance, all of those sort of rules, regulations, and the complexity associated with meeting the various laws and regulations, that's all going up. And what companies and their advisors can't do is just add more and more people and more cost, people-related cost to handle that complexity. So in a sense, our content-driven software needs to help them navigate that in a way that's efficient and effective and fast.
Steve, how are you navigating or managing misinformation that's associated with AI and making sure that you have the protocols, whatever is necessary in place in order to mitigate that risk?
Yeah, Shauna, this is key for us. So we as a company are governed by the trust principles, which came across with the Reuters news agency business. They were created in 1941 in the throes of the Second World War. They've governed Thomson Reuters' behavior since we acquired Reuters over 20 years ago. And basically what they dictate is that we avoid any bias, that we be independent, fact-based, and that we be very transparent in terms of the sources of our information. And also, an extension into the AI environment is we be very transparent about what outputs are produced by a human being and what outputs are produced by a machine. And we think that those principles enable us to apply responsible AI and indeed be differentiated in the marketplace.
When you earmark and make these types of investments, what is the kind of delta on your own margins that you look for, Steve?
Yeah, I mean, we in the most recent earnings call, we signaled to Wall Street that we're going to invest more. We think this is a once in a lifetime or at least once in a generation opportunity for us to better serve our customers using generative AI and broader machine learning technologies. We can't miss that opportunity. We've got to invest in behind it. So we've started that process this year with the partnership with Microsoft, with a $100 million investment that you mentioned in the opening, and also with the acquisition of a business called Casetext, which we think is the first business to really crack the code of combining large language models with unique data sets. So we've sort of set that process in train in 2023, and we'll continue it in 24 and beyond. And we will invest more heavily, but we think the results, first and foremost for our customers, are going to be very, very well received. And then we think that will flow through to higher organic growth for us in 25, 26, 27.
Steve, just taking a step back, I'm curious to get your perspective on leading a company the size of Thomson Reuters at a time like this, when there is so much uncertainty ahead, not only here in the U.S., but also what we're seeing globally, and how you're making these strategic types of investments at a time when many companies are cutting back some of their funding because of higher rates and what we're seeing about the uncertainty heading forward.
Yeah, I mean, it is an uncertain environment, and we've seen that in sort of pockets of our business where there's just a bit more caution heading through 23 and into 24 than perhaps we saw coming out of the pandemic. But we think, as I said, it's most important for our customers to invest in behind this. And I will say, Shauna, it's been incredibly energizing for our people to see us invest, to see us basically make a statement of intent that we're going to lead this generative AI environment as it pertains to the legal profession, the tax and accounting profession, the risk and compliance profession, and the news profession. And, I've had engineers say, look, I'm working weekends, not because I have to, but because I want to. This is really cool. We made a comment on our last earnings call. We said, look, our company's never moved as quickly, and we've never innovated at quite the same rate as we are now. And that's fun and energizing. Everybody wants to be associated with a business that's doing that. It does bring some risks, but we're increasingly confident that our shareholders will see the returns.
When you make a strategic investment like this and really kind of restructure the future financial performance vision for the company, does that also mean more interim restructuring charges that you have to take on, whether that's on a headcount basis or just looking across the divisions that are operated?
Brad, no, I joined the company almost 4 years ago, and for the first couple of years, we undertook what we called, wasn't very imaginatively named, but the change program. And that was really the hard work that you described, which was getting our tech stack in order, making sure we had the right people in the right places, and really reinventing the front end or end-to-end customer experience. We've gotten through that. So at the start of this year, we declared victory on that program. It ran for a full 2 years. We spent $600 million. We had a lot of turnover in our employee base. And I suppose to some extent that kind of work is never completely done. You're always looking for opportunities to do things faster and more efficiently. But the vast majority of that work, at least at Thomson Reuters, is done. So we think we've got a platform to make these generative AI investments, and we think we've got a platform to better serve our customers and grow faster.
Steve, always a pleasure to get some of the updates on where the business is investing and how you're bringing some of these solutions to life. Steve Hasker, who is the Thomson Reuters CEO. Thanks for the time, Steve.
Thank you.
Absolutely. Well, just this week, Nvidia marked its longest winning streak since December of 2016, and it's on pace to hit an all-time high. Well, not everybody is a fan of the AI champion. Yahoo Finance spoke with ARK Invest CEO Cathie Wood. In recent weeks, she's called the stock, quote, really expensive and very obvious, and suggested better ways to gain access to the sector. Here she is on why her flagship strategy doesn't own Nvidia right now.
I want to dig into a couple things. When we're talking about consumption, when we're talking about concerns, you would think it's going to affect one of your top holdings, and that is Tesla. Mm-hmm. And we've been hearing some commentary from the company that is not that positive. It's fallen to third in your portfolio. Mm-hmm. Is that why?
So what we did earlier this year, it was especially in July, summer months, we looked at Tesla up 150%, and many of our multi-omics names in the life science space, they were negative for the year. And this is portfolio management kind of 101. Huge profits there, losses here. Let's do some rebalancing. And so we did that, but we did not sell after their quarter. And we did hear Elon loudly and clearly, and we had been anticipating it. Consumer demand is weak. All that Tesla's price cuts have done is offset the interest rate hit. So really, the monthly payments haven't gone anywhere. Tesla will continue to cut prices because it can. Its technology costs are falling, and it's profitable. You'll notice that the GM and Ford have basically pulled back on their EV strategy and said, we can't do this unless it's profitable. Well, this is chicken and the egg. It can't be profitable for them, just like it wasn't for Tesla, until they scale. So if they're not going to scale, they won't be profitable. Meanwhile, we do think the consumer preference shift towards electric vehicles is in full force. And there will be demand destruction on the internal combustion engine side of the business. It won't disappear overnight, but the share gains will go to electric.
So no fundamental qualms on Tesla?
No, in fact, the GM and Ford pulling away tells us Tesla's market share in our 5-year investment time horizon is going to be higher than we thought. So absolutely not. Have we bought any back? Well, as I mentioned, many stocks during the summer period had waterfalls, especially in the multi-omic space, because they tend to be earlier stage, much earlier than Tesla.
So you preferred to buy there
so
rather than
we were buying
because
we really do believe we're at the end of the interest rate move.
There's one more stock I want to ask you about, but it's not one that you own. You can probably guess, maybe. Nvidia. Any regrets?
We own it in more specialized strategies. That's the first thing. We've taken it down everywhere. The flagship strategy does not own it because of our research. Now, everyone knows Nvidia has been the enabler of these amazing breakthroughs in AI, but they're not thinking about who the prime beneficiaries are going to be. And we've taken a strong point of view on that. Every stock in our portfolio, practically, is there with AI as a reason. There are four things they have in common. One, they have deep domain expertise in their own business. They're really good at what they do to begin with. Two, they have brought in AI expertise. They are taking this very seriously. Three, they have good distribution, preferably global, but maybe US only or regionally. And then after that, most important is proprietary data. Our companies have data that nobody else has. And they're going to be able to use the foundation models like OpenAI and Anthropic and Llama 2, which is Meta's. Those are free, they're open source. And they, with their own AI expertise, will build specialized models on top of those using their proprietary data. And they will get to better answers than any of their competitors and continue to leave their competitors in the dust.
So this also implies that even if, say, Nvidia came down in price, that you wouldn't add it back to the benchmark portfolio.
You know, it's interesting. It came down in price at the end of last year, like everything. And we did buy it back in because, according to our estimates, it was going to be able, at its lowest, to deliver a 30% compound annual rate of return. We thought, based on our research, compliance is listing 30% at a compound annual rate of return. That's a good return. It wasn't as good as many of the other stocks in our portfolio, but this is a special company. And to see it back down there, we said, okay, we'll put it. And then it took off because more and more people were talking about ChatGPT, and our other stocks continued to wallow. And so we did some readjustments at the beginning of the year again.
But going forward? Do you think?
So we are always open. We are very much driven by that rate of return estimate based on our 5-year model.
Right.
And we focus on enterprise value. So that incorporates bonds. It's not just, so it's conservative. And EBITDA, earnings before interest, taxes, depreciation, and amortization. You can't play games with those numbers like you can with EPS. Yeah. So we've got a very conservative profile. We think, just in terms of valuation, that's a question we get a lot. How can you pay these multiples? The reason we're paying these multiples now is because we want and we applaud that our companies invest aggressively now to capitalize on and be the winner takes most competitor out there. And so what we assume is that the multiples you see on our stocks today are going to compress dramatically during the next 5 years to little more than market-like in terms of, even though we don't believe that's the case. And our rate of return expectations are driven by revenue growth, margin growth, fighting that headwind of multiple compression.
Of course, our thanks to Kathy Wood and our very own Julie Hyman for bringing us that conversation. Keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
We've got much more coming up on Yahoo Finance in the next hour, zeroing in on small caps. How much upside is left through the year end? Our very own Madison Mills will give us that breakdown.
And addressing America's childcare crisis, we are going to hear from Bright Horizons CEO Stephen Kramer on the renewed push for childcare federal funding amid the risk of widespread closures.
And Netflix launched into live sports with its debut of the Netflix Cup golf tournament last night. Is live TV the future for streaming? We'll discuss here and see what those numbers look like for the first live sports event that Netflix put on.
We will see whether or not it was a big hit or not, but let's do one quick check of the markets before we let you go. Again, another day of gains across the board. You have the Dow up 150 points, Nasdaq up just about 0.6%. Akiko Fujita and Rochelle Kufo have you for the next hour.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita with Rochelle Akufo. Here's what we're watching at this hour. Target shares flying high today after strong earnings signal a resilient consumer. But is retail theft still a top concern? We'll discuss.
And real estate reconstruction, how a set of lawsuits are shaking up the industry and what it means for the future of buying and selling homes.
Plus, funding fallout, how the ripple effects of childcare closures are affecting employers and the U.S. economy as a whole. A conversation with the CEO of Bright Horizons is coming up later this hour.
That's right. But first, let's take a look at how the markets are faring an hour and a half into the trading day. Continuing that momentum from yesterday, the Dow currently up about 0.5% or 168 points. The S&P 500 also up just over 0.5%. They're up 24 points. Tech-heavy Nasdaq, of course, strongest gainer of the day, up about 88 points. We are seeing sector-wise materials leading at the moment. And on the Nasdaq, Amazon, Nvidia, and Meta under pressure. Tesla, though, showing a strong signs here, up 3.5%. A lot of information for markets to digest today, including retail sales. So let's check in on what we're seeing with the Treasury market as well. We saw that across the board here, looking at some solid greens, a different story from what we saw yesterday when we saw the equity markets racing up, but also now seeing Treasury yields racing up as well. The 5-year up about 2.25%, the 10-year also up over 2% on the day, and the longest 30-year yield, that's also up about 1.5%, 1.4 on the day. Well, consumers are losing that pep in their step. Retail sales in October turned negative for the first time since March. Now, this could be a win for the Fed as it signals a slowing in demand as we approach the last FOMC decision of the year. Let's break down how data like retail sales impacts the Fed with our very own Jared Blickery. Hey, Jared.
That's right, Rochelle. As you said, retail sales did just drop into negative territory, but they were down about 0.1% in October. But there's evidence that the consumer remains strong, something the Fed and policy officials have been hammering. First, digging into the numbers, the majority of categories declined, with furniture and car dealers leading. The weakness in bigger ticket items was echoed by Home Depot and Target earnings earlier this week. But Wall Street was concerned that gasoline sales would drag the headline down further than it actually did. The better than feared number is also buoyed by the upward revision to prior months, adding to evidence that the U.S. economy is not imminently heading into a recession. Now, stripping out autos and gas for October reveals a surprise 0.2% increase. The so-called control group, which strips out even more categories, that is also up 0.2. Now, Americans were amped up. They amped up their personal care and grocery purchases. That latter group up 0.7%, big jump there for 1 month. Meanwhile, restaurants and bar spending, that also looked positive, up 0.3. Now, the relatively strong yet not too strong numbers are in line with the latest thinking by Jerome Powell and his Federal Reserve cohorts. While Powell has been careful to say a soft landing is not his base case, that has become the de facto expectation on Wall Street. Meanwhile, today, we also got producer inflation numbers. This morning, final demand headline number that surprisingly dropped 0.5%. Street was expecting a small positive print there. Taking out food and energy, producer prices were flat month to month. This echoed the headline print from yesterday's consumer inflation print. As we can see on the charts, inflation has been trending in the right direction most of the year. That is down. We've had some pretty volatile results, but this uncertainty has at times, it has rocked equity prices. What we've seen, or what we've yet to see, is any kind of smoking gun that points to that all-elusive imminent recession. So getting back to the Fed, we just don't have the evidence for more rate hikes, and the street is liking that.
Certainly liking that given yesterday's rally and the extending of those gains today. Thanks so much, Jared. Well, stocks continue to surge as the latest economic data points to cooling inflation and a slowdown in consumer spending. Investors are now betting that the Fed's job is done for now, spurring this market rally. So where are the best buying opportunities at this time? For the answer, let's bring in Ken Mahoney, CEO of Mahoney Asset Management. Ken, I hope you have some answers here, but let's start with that data that we got today. As Jared noted, we saw the first monthly decline in that headline number in a while, but we're still talking about a resilient consumer. How long does this last?
I think it has more legs. Like, we came into January this year and everybody said, we're going to have a hard landing. The only question is the cockpit going to fall off, or is the fin or the tail going to fall off? I mean, I was so convinced. And now, in the last couple of days, between the Department of Labor's report on Friday, the CPI yesterday, the retail sales started to add up that wait, maybe we were wrong about this hard landing. Maybe this is Goldilocks after all. Goldilocks, hey, not too hot of an economy to have the Fed raise rates. They're on a pause, and market's not on a pause whatsoever. They're off to the races, and yet not too cold for companies not to have decent earnings. So this is now being recognized as a sweet spot between now and the end of the year. We don't see any, Fed increase or Fed fund rates increase, and they're out of our hair. And we may have some performance anxiety. Those who are bearish, from pretty much this entire year, probably have to hold their nose and pick stocks, but they have to keep up with the Joneses if they're going to get their bonuses.
So then, Ken, talk about some of the sectors where you see the opportunities. A lot of people still had money on the sidelines wondering, should they be chasing bond yields? Where do you think is the best place to put money to work right now?
Look, I still like big tech. And look, no doubt we've had a tale of two stock markets. One is technology and everything else. And now we're starting to see the everything else, including small cap, as you profiled earlier. The small cap index was up 5% yesterday. That's ginormous. But we still see liquidity in these big names, Apple, Microsoft. These are companies that beat estimates, for the quarter, September 30th. These are the same ones actually guiding higher. Look, they need to take a breather, no doubt. I mean, some things are nosebleeds here. We get it. But remember, we were deeply oversold August, September, and October. And now we get some breathing room in November. So it may have more legs. But I'm still sticking in to the fabulous seven, so to speak, and be willing to buying any pullback.
And when you think about the market reaction to yesterday's inflation print, looking at where stocks have continued to extend their gains today, how much of this is just sort of that knee-jerk reaction? How much of this you think are levels that can be sustained, to your point, with the expectation that it's not just a pause anymore, this tightening cycle may have peaked?
Right. So I think this has legs. Now, look, will I be adding money today? I don't know. This is kind of overbought very quickly. The market goes very quickly. Oversold. No one wants stocks overbought. But remember, we were looking for a catalyst to get some of these $1 trillion out of the money markets and into the market. And I think, this FOMO's come back to town. FOMO, fear of missing out, at least fear of missing out this rally in November. And, that can have a lot longer legs. Just like, when sticking to the downside, like, oh my gosh, when is this negativity, this Chinese torture going to end, the August, September, October days. And just on the other side, it can stay sticky for some time because FOMO is very real and momentum can carry for quite longer than people expect it can.
So Ken, as Jared was mentioning earlier, obviously we're seeing the markets looking ahead, pricing in for a soft landing here. The Fed is saying, no, that's not the case. Markets not believing them at the moment. What are some of the risks that people should be aware of as they're trying to not fight the Fed, but markets have obviously jumped ahead at this point?
Yeah, look, the expectation is the Fed is done. They may not be done, right? We may get a hot PPI number, CPI number somewhere along the way, and that would quickly have yields go higher. This whole year has been seesaw. Higher interest rates, lower stock prices, lower yields like we saw the last few days, higher stock prices. So, I can't say we're out of the woods together. It's still very data dependent. But I will say this, though. A lot of people are talking about these rate cuts happening next year. I don't see that. Again, I know Fed fund futures are showing by May, maybe a rate cut or two. I do believe it's going to be higher for longer. They may not raise rates, but I think they're going to keep it longer. And be careful what you ask for. If you ask for rate cuts, what's accompanied with rate cuts? Probably like a negative GDP print. So be careful what you wish for.
So Ken, if you expect those rates to remain where they are right now, do you stay away from growth names? Because that's where they've really suffered, right? I mean, the expectation here that the higher rates have hurt so many of these companies that have taken on a lot of debt.
Right, they have it. But again, a lot of these growth companies, though, I think are set up pretty well. A lot of the growth companies do wrap around new technologies like AI, software learning. We're in that hockey stick of growth right now. Higher rates definitely dampens the spirit of growth names and so forth. But if the argument is we're going to go to some type of recession next year, I would actually argue that a lot of these same technology companies are somewhat shielded from that. I mean, we're still going to use our Apple phones. We're still going to do Google searches. We're still going to buy on Amazon. We're still going to use our Microsoft team meetings. And, so again, I think there's, again, it can go both ways, obviously, but we think it's going to go positive because really, I think investors at this point in this market cycle want to see consistent earnings, and these big companies do deliver those consistent earnings.
Certainly seems to be the case so far. Ken Mahoney, CEO of Mahoney Asset Management, thank you for joining us this morning.
Thank you. Have a great day.
Thank you, you too. Well, shares of Target are rallying this morning. That's after posting earnings results that beat estimates and are being considered, quote, better than feared among analysts. But multiple headwinds are still up against the retail giant, including sales decline and higher inventory shrink like retail theft. Our Brooke De Palma joins us now with more on this. Brooke, we knew that we'd been hearing about this in previous earnings call. What did they mention about shrink on this call?
Good morning, Rochelle. Well, it's important to note that inventory shrink is not just retail theft. In addition to that, it's organized crime, it's damage, vendor fraud, as well as other factors. But inventory shrinkage does continue to weigh on Target's earnings. And on a call with investors, Target CFO Michael Fidelki said that growth in shrink remains a, quote, significant financial headwind. He also provided more color when asked if the retail giant started to flatten the curve on shrink.
In the third quarter, we still saw year-over-year pressure, so about 40 basis points of year-over-year headwind. That's less pressure, relatively, than we saw in the first 2 quarters of the year, and it was a little better than we thought it'd be. And so those are, encouraging signs of some progress in the right direction, but to be clear, still a year-over-year headwind in Q3. And so, as we've said before, shrink's a lagging metric.
And to make that ultimately very clear, it's still a headwind compared to last year, but it is starting to moderate compared to the first half of this year. He went on to say that it's important to note that this does not mean that Target has turned the corner on shrink. And he added that they'll continue to watch these trends very carefully, as we here at Yahoo Finance are as well.
So what does that ultimately mean in terms of what Target is doing to combat the issue?
Yeah, Kiko. Well, we know back in October, towards the end, on October 21st, they closed 9 stores across the U.S. Now, Target claims that they closed those stores because they were contributing to unsustainable business performance, and ultimately theft and organized crime were threatening the safety of their team as well as guests. But we know at large, in addition to that, this is a $112 billion problem for the industry. And so we've seen Target add other methods like locked cases, more security at stores, and cyber defense technology. But what we've heard from other executives like Walmart is that typically when there's more inventory in stores, there's more shrink, there's more theft. And so that's ultimately contributing to the problem as well. And what we've seen Target do is really combat their inventory issue that they had last holiday season. They did see inventory drop 14% year over year. Now they're really working to create a more efficient inventory management system. So those are just a few ways that Target's combating this.
And Brooke, we have to talk about how the stock has been moving, especially since the earnings were released. Break that down for us.
Yeah, well, Target stock right now definitely is soaring. If I see it right here, it's up roughly 18%. It's also on track to have its 3rd best day ever. And this is largely because, as you noted earlier, Rochelle, that this was a better than feared performance in seasonal, back to school, and holiday assortments. They're also working on creating a stronger inventory management system. And the company said that it does expect the holiday quarter to look roughly the same, with comparable sales in a range of around a mid-single-digit decline. And so really Target painting a clear picture for investors here, setting the story straight, and we see Wall Street applauding that today.
Yeah, nice pop, but on the year still down more than 12%. Worth noting. Reporter Brooke De Palma, thanks so much for breaking that all down for us. Well, coming up, a big day for President Xi Jinping. China's leader sitting down with President Biden and business executives in San Francisco. What these talks could mean for China's economy, we'll discuss on the other side.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
How does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Now time for today's chart of the day. The Oracle of Omaha made some big investment exits in the third quarter, selling $7 billion in stock. Now, Warren Buffett's Berkshire Hathaway completely sold off its holdings in General Motors, also ditching stakes in J&J and Procter & Gamble. That's according to a regulatory filing Tuesday. The company also trimmed holdings in HP and Chevron. By the end of the third quarter, 78% of Berkshire's stock portfolio was concentrated in 5 companies: Apple, Bank of America, American Express, Coca-Cola, and Chevron, with Apple dominating more than half of the company's holdings. But Buffett still falls slightly behind the broader market. Year-to-date, shares of Berkshire Hathaway are up 15% compared to the S&P 500's 17%. Now, obviously, Akiko, we know that Berkshire Hathaway, it is about the slow and steady wins the race. They do like their tried and true, especially when it comes to Apple, American Express, and of course, Coca-Cola, one of his favorites. But then he's also looking for companies with a moat, not looking for a lot of these companies that have started splitting off, having some other issues there. Interesting, though, did pick up shares of Sirius XM Holdings, which I thought was interesting, because when I think about the moat around Sirius, that's not as clear to me as some of these tried and true ones here.
Yeah, they're sort of the traditional checklist, right, that Warren Buffett likes to keep. You could argue some of his more, sort of newer holdings don't necessarily follow that all the way. But of course, we are talking about Warren Buffett's holdings because of his track record with some of these stocks. And Rochelle, you mentioned some of the big ones that he sold. GM, that stock is down 16% year to date. We should mention J&J also down. P&G pretty flat on the year, so he's not necessarily going against the tide on that. We should point out he was a net seller, he as in Berkshire, we should mention, a net seller of stocks in the period, unloading about $7 billion in shares. You mentioned one that he picked up. The other one that's interesting to me is his bet on Major League Baseball. Our very own David Hollerith writing about this on Yahoo Finance today. $8 million in buying up a new position at Atlanta Braves Holdings. So yes, you can own the Atlanta Braves because they did split from their old parent company, Liberty Media. But that's an interesting one to me. Warren Buffett's talked about his love for baseball. Now he's got a holding in it.
It's true. And he's a big believer of buying the things that you love, which is why you're always going to see Coca-Cola on the list. And of course, he always speaks very highly of Apple's leadership. Apple's one of those companies that, even though they've been having some issues in terms of forecasts for sales for the iPhone, some softness, some weakness in demand here, that's always going to be one that's on the top of his list. They're too far ahead of everybody else in terms of the moat that they have and the ecosystem that they have as well.
Yeah, no real significant move, by the way, on some of these stocks that he sold, but we're watching that one really closely. Well, President Biden and China's Xi Jinping are meeting this afternoon for the first time in over a year. The highly choreographed sit-down on the sidelines of the APEC summit comes at a critical time for the world's second largest economy, recovering at a steady but slower than expected pace. A weak property sector and subdued export demand remains China's biggest economic hurdles. Several U.S. CEOs are also attending the week summit and set to secure some face time later tonight with Xi at a private dinner. Shahzad Qazi, China Beige Book's international managing director, joins us to break it all down for us. Shahzad, the White House has set the bar pretty low here, saying that this is really just about keeping the lines of communication open, managing competition. As you see it, what would be considered a success coming out of this bilateral summit?
Well, look, the real issue with the summit is that there are no actual deliverables to be had. None of the actual problem areas between the two countries are being discussed. This is a very choreographed, stage-managed meeting. It kind of just, comes at the heels of a series of high-level official visits from the U.S. to China and from China back to the U.S. as well now. So quite honestly, for markets, there really isn't much to be gained or to be read into when it comes to this meeting. There really, quite frankly, isn't much of substance going on today.
Shahzad, you could argue that part of what we're watching right now, as you point out, it is about what's happening on the APEC CEO summit, because we have so many executives that have come in looking to have FaceTime with Xi. What's the message that you think the Chinese president sends to these companies at a time when there's concern about the growth potential in the country, as well as domestic policies that have put a lot of these multinational businesses in a tough spot?
Yeah, this was supposed to be the year of the foreign investor or foreign investment in China, but of course, what you've seen happen is continuation of a series of crackdowns on executives, on different companies, on different sectors. So the policy crackdown, if you will, in China, or the tightening of the regulatory space continues. The message to CEOs, of course, remains China's open for business, and we welcome foreign companies and foreign executives to come in. Now, you don't really have to sell foreign executives, I think, on China very much still. I think the business community, the CEOs are, I think, some of China's best friends in America. They very much remain sold on the China story if it's looking at China as a market. And not exclusively as a place of production. And yes, they want to diversify their supply chains and so forth. But nobody's just getting up and leaving China. Certainly nobody is going to be at this dinner today. And these are the big American companies that have undergirded this economic partnership between the U.S. and China for the past couple of decades or more now.
And Shahzad, it's interesting because when you look at the relationship between the two economies, but when you look at the relationship between China and some of these businesses, they do seem to be moving in a different direction here. What does that mean then? What should we be focusing on? How the CEOs are still developing their businesses with China, or the larger sort of security and economic relationship between the US and China?
Yeah, there's no doubt in my mind that geopolitical risk has risen in a very, very significant manner over the last, at this point, I would say 45 years. And American CEOs in general doing business in China need to start getting very, very serious about the security risks, about the geopolitical competition, and about the risks that they face, regulatory risk and policy risk inside of China. That era of saying, oh, there's a brief period of crackdown and it's going to be over, or no, the party is always pro-business, so they won't go too far. That has been proven to be consistently wrong. It has led to a lot of losses. So my message to the CEOs, as always, is get serious and get real about political risk.
Yeah, and that points to some skepticism that Xi Jinping's likely to face. We should point out, Shahzad, this is the APEC summit. It's not just about China. There are a number of leaders that have flown in from Southeast Asia, from Japan, from South Korea, who are all eyeing this renewed skepticism and caution business leaders are approaching the Chinese market with. What kind of opportunities do you think that opens things up across the region ex-China?
Yeah, I think we've already seen some examples of it with the trade war or the tariff war from the U.S. side has led to things like a lot of Vietnamese factories trying to gain. You've seen India that is really trying to move into certain areas like chemicals and IT, electronics, and so forth. There's no question that these other Southeast Asian countries are going to be making a strong pitch for why they need to be added to the supply chain basket of these major American corporates. I think the question that the CEOs and their staff will be wondering about continuously is, do these other countries have the capacity to become big players in that supply chain? That's really one of the core, I think, hurdles, if you will, when we think about diversifying supply chains out of China. Who can really step up? Who's got the capacity, the infrastructure to make it all happen?
And Shahzad, when you look at where China's growth was, obviously it had, was racing ahead at breakneck speed with its GDP growth. Now we're in a very different period for China's economy. What are the biggest selling points then for people who are trying to invest in China when you're seeing a slowdown in consumption and a slowdown in growth and a different sort of new normal for China here?
Yeah, the investment landscape has really been shaken up, even though I think a lot of folks in the market are still not really being able to grapple with the big change in the China economic playbook, which is that they no longer want to have an economy that grows at a very fast pace, but comes with the risk of high levels of debt and investment, that really isn't paying off, the bridges to nowhere. They do want to move towards something much more sustainable. So first of all, I think anybody looking to invest in the China market or looking to be long-term players in China, you need to grapple with the reality that the old stimulus-driven model of economic policy making is out the window. It's not going to happen. Slower growth, sub 5% growth is absolutely baked in. The real question is, can it be driven by something far more sustainable, by domestic consumption? Or when we say 5%, we mean that growth just absolutely crashes and you start getting into periods of stagnation, no growth, or something like 1.5% growth, which would be a very, very scary time for anybody investing in China.
Indeed, always have to keep aware of the risks there. Appreciate you joining us, as always, Shahzad Qazi, China Beige Book International's Managing Director. Thank you so much. All right, coming up, can small caps stand up to the big boys? Our very own Madison Mills explores how much upside is left for those little stocks. Plus, also taking a look at the deep dive into Cathie Wood's ETFs, including a new crypto-focused index. Are they worth the hype? We'll discuss next.
Well, the market rally is extending to small caps as the Russell 2000 continues to climb today. But will small caps have much more upside? We've got Maddie Mills with a breakdown. Maddie, this is something that we have heard from so many guests who are saying we're very bullish on small caps moving forward. What's the longevity?
Right, that's the million-dollar question here, Akiko, right? We are seeing this rally over the past couple of days, but does it have legs? I want to just explain the context behind this rally that we're seeing here. Obviously, this is when we got that CPI print yesterday, seeing a 5.4% rally in the Russell 2000, marking the highest day in the year for that index. But also continuing into today, we thought maybe we'd see a little bit of traders getting out of that play today, but we're still seeing that longevity. Now, I do want to compare it to some of the other mega cap indices year to date. If you look at the S&P up 17% year to date, now we look at the Nasdaq up 35% year to date, and then I go over to the poor Russell here, only up 3.6% year to date. So the question is, why are traders rushing into this? Well, hedge fund managers that have dry powder that have been sitting on the sidelines this year, it's November. They've got to prove returns to their clients heading into the end of this year. So they're looking at the Russell and they're saying these are some companies that have lower valuations, good fundamentals, lower valuations than their counterparts in large caps that you're going to see in an index like the Nasdaq. And it's a great place for them to maybe have a catch-up trade. And that's part of what goes into something that we call the January effect from a technicals perspective. If you look at the Russell 2000 going back to 1979 here, right, you see that it typically has a rally heading into January. And so that January effect could be a boon for, again, anyone who's been a little bit on the sidelines, hoarding some cash as there's been a little bit more market volatility amid these Fed rate hikes.
And that certainly tracks from a technicals perspective. But what about the fundamentals when it comes to small caps?
Yeah, it's so interesting. Our colleagues in the 3 to 5 show, Josh Lipton and Julie Hyman, were talking with Eric Green yesterday about this. And he made a great point that these small cap names in the Russell 2000 might be able to do a little bit more deal making as we head into next year. Again, particularly if the Fed does start to pull back on rate hikes, we might see a little bit more investor sentiment and company sentiment, rather, to get in on some deal making, some M&A, and that could lead to higher fundamentals for these small cap names. And again, the valuations are there. They're pretty solid. The fundamentals are looking good. Investors say that the Russell 2000, every single sector is expected to grow in the fundamentals heading into the end of this year. So that could be a boon for traders heading into 2024.
See, Magnificent Seven gets all the love, but here's the little guy here, the small caps. Appreciate that, Madison Mills. Thank you so much. Thank you. Well, investors in the crypto space are keeping their eyes on the SEC's spot Bitcoin decision, with the January 10th deadline quickly approaching. Our very own Julie Hyman spoke with ARK Investments' Cathie Wood about movement in the space and the potential for SEC approvals. Take a listen to what she had to say.
This summer, we got questions back from the SEC. Now, normally when you get questions from the SEC, you're just saying, oh my goodness. We were thrilled to get questions back because it means they're engaged now. Now, we have met a number of the research people at the SEC on the research side, and they are extremely sophisticated. They know what they're talking about, and the level of sophistication of their questions suggested, okay, now they're moving deeply into this.
As part of our ETF report brought to you by Invesco QQQ, let's bring in Advisors Asset Management Head of ETF Product, Lance McGray, to discuss more. Thank you for joining us this morning. So first, want to start with what we heard from Cathie Wood about the optimism that we're seeing and the momentum towards a potential spot Bitcoin ETF approval here. In terms of the likelihood, are we liking this momentum, and perhaps how soon could we see it?
First off, thanks for having me. I think there is plenty of optimism out there, right? At the end of the day, you're talking about a $700 billion market cap universe that has been rather untouched from the ETF industry. So Cathie is extremely optimistic on the conversations that they've been having with the SEC. But let's not get too far ahead of ourselves. These conversations go all the way back to 2017, when the SEC essentially rejected its first spot Bitcoin ETF. So again, while the SEC is coming back with conversations, and that's good news for investors that are looking for a spot Bitcoin ETF, let's not forget the mandate of the SEC, and that's really to protect the investors with products like this. So I anticipate things to be moving smoothly, things to continue moving. But quite honestly, I would be shocked if something happens in 2023. Probably looking at more back half of 24 than anything else.
Back half of 2024. Well, we only have a few months left, or 1 month almost left in 2023. Lance, this has always been seen as a catalyst, that next leg for crypto. I mean, what's the interest been like among your clients? What are you hearing?
there's interest, right? Specifically around the spot Bitcoin, right? Because right now there are futures-based ETFs, right? The SEC has got comfortable with futures-based products because these are securities, these are on exchange where there is regulation. Their concern is really around the manipulation and the fraud tied to the underlying spot market. So there is appetite, right? There's been a recent poll that came out last year that says, if there's a spot Bitcoin product that comes out, there's a 72% appetite for investors to get into that product rather than the current futures product, right? And we talk about the futures products. Yes, it is essentially tracking Bitcoin, but it's important to remember that these futures products wouldn't operate the same as a true spot Bitcoin product, right? There's going to be roll costs, there's carry costs, there's contango, there's different costs that come into this, right? And at the end of the day, what the investors are telling us is that they're looking for a spot Bitcoin ETF rather than a futures-based ETF, which we currently have in the marketplace.
And we are expecting that if this does get approved, there will be a wave of these. But one of these in the mix here is also Grayscale, trying to convert its fund to an ETF. Not a lot of know is about this process. I know Kathy Wood was saying she wasn't sure if Grayscale would be able to do that. What do people need to know about that conversion process and what that opens up?
Yeah, well, that's a big thing in the ETF industry right now, right? I know we're talking about Bitcoins, but let's just look at mutual fund to ETF conversions. This is something that's just recently coming to market over the last few years. And we've seen in the last year or so about 50 conversions come to market and about $75 billion of assets that have come over from other wrappers, specifically the mutual fund wrapper, into what is perceived to be a more tax efficient, a more flexible, a more transparent wrapper, the ETF wrapper. So we fully expect that we're going to see these. We're going to see this continue to roll out. We think there's a major trend on the active management side, whether it's crypto or fixed income or equity. There's going to continue to be these mergers or conversions from one wrapper to the next. And when we specifically talk about mutual fund to ETF conversions, right, there's from an issuer perspective, let's talk about the benefits, right? The first and foremost is that the track record from the mutual fund. If you have a mutual fund that has a track record of 10, 20, 30 years, that track record can come over to the ETF, right? So that's fantastic news. Mm-hmm. The other thing in the ETF space, is getting scale on day one. If you can bring over assets in from a mutual fund into an ETF, right? The hardest thing for us to do as an ETF issuer is to get that first $100 million. And when we're doing these conversions, you can get that scale on day one. And then finally, you have improved tax consequences of the mutual or of the ETF over other vehicles like the mutual fund. Mm-hmm. So, this is something we're going to see a lot of in the coming years. And I think it's one area that's really going to take the world of ETFs to the next step is active management and conversions of other wrappers into ETFs.
It's certainly a lot to consider in a growing industry, to your point. Advisors Asset Management Head of ETF Product, Lance McRae. Good to talk to you today. Really appreciate the time.
Thanks for having me.
Well, coming up, potential shakeup in the housing sector. Our very own Alexis Keenan and Danny Romero dive into the broad implications of a lawsuit against the National Association of Realtors. Plus, breaking down the childcare access crisis with the CEO of Bright Horizons. That conversation up ahead.
It's the lawsuit that's shaking up the housing industry. The National Association of Realtors and several brokerage firms face likely damage payments of $1.8 billion or more after a federal jury said home sellers faced inflated broker fees. Yahoo Finance's Alexis Keenan and Danny Romero join us with the details. Alexis, first, we'll start with you to set the scene. From a legal standpoint, what are we seeing here?
Yeah, Rochelle, so this is really the floodgates opening in the real estate industry and the brokerage industry. This $1.8 billion verdict, it came from a jury in Missouri, and it was about 2 weeks ago, and it was a class action case, and it was alleging antitrust violations, federal antitrust allegations. And this case, though, while it was a $1.8 billion verdict, the damages in this case could swell all the way to $5.3 billion. Now, the case has since spurred additional kind of copycat cases across the country already since that case, a case filed by buyers in Illinois, also sellers in Missouri, New York, Texas, and South Carolina. There's also an Illinois case that was filed in 2019 that is set to go to trial next year. Now, by and large, these cases are brought by plaintiff sellers of residential real estate in the U.S. They say that the National Association of Realtors conspired with real estate brokers, forcing sellers to pay commissions for not only their own broker agents, but also for the buyer's commissions. How do they do that? They say, well, the NAR, they control the powerful database that houses the listings known as MLSs. They exist across the country, regionally, locally, and they have about 90+% of all the homes for sale listed in that database. So what does the NAR do? They say only its members can access that database, and then those members are required to share commissions. Now, the end result is if the sellers use these services, they then have to pay both sides of the deal. Now, ultimately, these plaintiffs, they say that all of this relationship between the NAR and the brokers, that this is driving up home prices across the U.S.
Danny, what does this ultimately mean for the future of buying and selling homes? How are things going to shake up?
Akiko, consumers are upset on how the commission structure is done on real estate transactions. But before we get into the changes, how are transactions typically done? Well, if you want to list a home for sale, you usually go through a multi-listing service, and which gives access to agents on local real estate databases. So when that happens, the seller pays a commission towards that agent that brings that buyer, that lucky buyer, through the door. Now, typically home sellers are on the hook for about 5% to 6% cut on the home sales price, and then that's split between the buyer's agent and the seller's agent. Now, there is a catch. The buyer doesn't pay that fee directly. Instead, the commission is fully paid by the seller as part of their closing costs. But with these lawsuits in focus, the change has already happened. I mean, for example, in California, the California Association of Realtors has already made changes to their purchase agreement last year. Now they have a section that's called the seller's payment to buyer's broker. And that means, that indicates that the buyer has entered a written agreement with the to compensate the buyer's broker. And the seller has to agree to that obligation, whether or otherwise negotiated. That's just one example of some of the changes that has already happened. Another example is if you want to list and sell your home in January, I spoke with experts that this is the time to really aggressively negotiate down those commission fees with the real estate agent. Another expert said that with high home prices, the structure could actually move towards an hourly fee instead of a commission-based structure. That could be a little bit of outside thinking, but again, it's just an option. But at the end of the day, experts say that there needs to be an incentive on the table to bring buyers through the seller's door. Akiko?
Danny Romero and Alexis Keenan breaking down the implications of NRA's lawsuit there. Well, the government's facing a renewed push for childcare funding. Senators, including Tina Smith from Minnesota and Elizabeth Warren from Massachusetts, are urging congressional leaders for a new funding package after the Childcare Stabilization Grant, which was passed in 2021, expired at the end of September. Aside from climbing expenses, the childcare industry is also facing an influx of closures over lack of funding, shedding jobs from the economy and leaving parents without access to care arrangements. For more on the state of childcare, we're joined by Stephen Kramer, Bright Horizons CEO. And Stephen, I will start by saying that this is something Rochelle and I are very familiar with, having to look for childcare. Let's start with the implications of that funding expiring in September. We heard a lot of the doom and gloom scenarios. How has that affected Bright Horizons?
We always had known that this ARPA funding was going to sunset. And so we really managed our business with that understanding. And I think the secret sauce behind Bright Horizons has always been the support that we garner from our employer clients. And so unlike community-based providers who are responsible for having parents pay the entire freight of childcare in their tuitions, we've always had this third-party support through employers. And so again, it's been a critical support over 35 years. And in the face of the ARPA funding sunsetting, this continues to be an important source of support and subsidy for working families.
And Stephen, since that sunsetting, have more employers been approaching you to try and offset some of these costs for their employees, or are they still trying to figure it out when they think of other sorts of labor costs and other sort of perks that they have to pay?
Yeah, I mean, we're certainly seeing a renaissance in interest around childcare and specifically employer-supported childcare. I think that employers recognize, and they're hearing it directly from their employees, that they are struggling with access, with affordability, and the quality of childcare in the general community. And so employers are really trying to figure out ways that they can invest. And obviously, Bright Horizons is in the middle of those conversations, given the long history we have in supporting employers as they support employees in this important area.
Stephen, that's certainly interesting to hear about the knock-on effects. I mean, employers increasingly interested in teaming up with a company like Bright Horizons because they're losing employees because they can't find childcare. As you look at that partnership that you've got in place with employers, how big of a revenue driver is that going to be, or how much bigger of a pie is it going to take up when you look at the overall revenue picture for the company?
Yeah, it's an interesting question. So when we think about the employer support that is garnered, first and foremost, our employer partners are critical in providing the capital and the space to build out high-quality childcare centers that we ultimately manage. And through that direct support, we're able to provide ongoing support to their employees in terms of great access, as well as affordability to high-quality childcare. In addition to that, they offer other services through Bright Horizons, including backup childcare, right? So when there is a breakdown in care arrangements for an employee with a child or even an aging elder, employers have the ability to support that employee to get care arrangements through Bright Horizons. We saw tremendous growth over the last several years in that line of our service, and that continues to be an area, in addition to on-site childcare centers, that employers are interested in supporting.
That's certainly welcome news for a lot of people. Nothing worse than, waking up, your child is sick, or you get that phone call from the school and you have no sort of backup care. Throws everything out of whack. Appreciate you joining us this morning. Stephen Kramer, Bright Horizons CEO. Thank you so much.
Thank you very much.
Well, Netflix took a swing at live sports last night. So was it a hit or a miss? We'll discuss next.
Netflix teed up its big launch into live sports with its debut of the Netflix Cup. Stars of 2 Netflix sports series featuring athletes from Formula One, Drive to Survive, and Full Swing battled it out in a one-off golf tournament in Las Vegas last night. Did the streaming giant hit a hole-in-one with this event? Let's bring in Ali Canal, who has the details for us. Ali, by the way, when this was first announced, we had a debate. Like, this isn't really live sports as we know it.
No.
But it does point to an interesting strategy for Netflix as they sort of eye their competitors getting into live sports and, figure out what they want to do with it.
Yeah, absolutely. And I tuned in for about 25 minutes. I was very curious. Right away, I could tell this is a production that Netflix took some time in. There were different camera angles. It was really a behind-the-scenes look at these players. And really smartly, we also saw Netflix incorporate a lot of the programming that they have. So, for example, they were really pumping out the Squid Game, game that they're going to be hosting on the platform. And they had players basically participate in these games where they had to shoot their shot off the tee before the killer Squid Game robot girl turned her head around. So kind of gimmicky. I don't think if you're a hardcore golf fan, you got anything out of this. It was really kind of leaning in to the amateur aspect of it all. We had different types of hosts like former NFL running back Marshawn Lynch, comedian Bert Kreischer as well. So they provided some levity there. But the big question that I was looking around to see what did people actually think of this was, do the audiences need something like this? What was the audience at the end of the day? Netflix hasn't released any viewership figures at this point, but as you mentioned, it does open up an interesting opportunity and an interesting door for Netflix when they assess how they want to approach sports moving forward. And obviously, it's great promotion for Full Swing, F1. Those characters from those docuseries for Netflix really kind of shined through within this Netflix tournament, and we'll see if they continue to do live events like this. But overall, wasn't for me, I don't think, but I'm sure people that are casual fans of the sport and are fans of the actual players might have enjoyed it, logging on and tuning in for the live portion of it.
And certainly a way for Netflix to dip its toe in without sort of risking it all by trying to, go straight in with a live NFL game or something like that. Appreciate you breaking that down for us, Ali Canal. Thanks so much. All right, well, let's get you a final check of the markets as we head into the noon hour. Still looking at green across the board, though some of that buying action has slowed down a bit. We're seeing currently the Nasdaq up about 1/3%, or about 100 points. The S&P 500 also up about 10 points on the day. Tech-heavy Nasdaq also up in similar territory there, up about 0.2% there, or about 27 points. The Russell, though, still off to the races, though, up about 0.9% on the day. That does it for now. I'm Rochelle Akufa with Akiko Fujita. Thanks for watching. We'll see you tomorrow.